Welcome to the European market open. A minute to go until the start of cash equity trading. I'm Danny Berger in London alongside Tom McKenzie.
Good morning, happy Friday. Here are your top stories. It is jobs day. Traders watch for any clues on the prospect of a faster taper from the Fed. European futures point higher after the US snaps a losing streak. DD delisting, the ride-hailing giant begins plans to withdraw from US exchanges. We will bring you that Bloomberg scoop. Plus, Nvidia's plans to become king of the chips hits the rocks. The FTC sues to block its $40 billion acquisition of ARM.
Well, 15 seconds to go until this market opens. Futures indicating it might be another day of catch-up after Wall Street rallied yesterday. We are seeing some positive action on the DAX, on the Euro Stoxx 50 futures, up about 0.9%. But Tom, on these kinds of days where we're waiting for jobs numbers, big data numbers, we might get a little bit of a holding pattern.
Yeah, and there's, of course, a discrepancy. There always is around the numbers we're going to get in terms of non-farm payrolls. The Bloomberg intelligence line is you're going to get a print of 700,000. The surveys from Bloomberg is it's going to be closer to 550. What that tells us about the pace of taper, and then, of course, following on from that, the Fed rate hikes, of course, is central. The whipsaw that we've seen across these US markets this week has been pronounced, of course, and now you have a further flattening of that yield curve. Here in Europe, the focus remains on the pandemic, of course, as well, given that Germany is moving closer to that mandate for vaccinations, taking additional steps as infections continue to rise. You're seeing gains of 0.7% here in the UK. The FTSE 100. Oil, don't forget, is high on the back of that OPEC plus deal and move to continue output production. The CAC Cajon is up almost 1%, and over in Spain, you're seeing gains of 0.8. Let's change it over and have a look at how things are playing out cross-asset as well. The futures in the US pointing to modest gains of 0.2%. The story when it comes to Chinese tech listed in Hong Kong is one of brutality, a loss of almost $1.5 trillion since February, near record lows now on the back of the news that DD is going to start delisting its ADRs from the US. Also moves by the SEC to make it that much more difficult for Chinese firms listed stateside, following down close to 2%. The yield on the US 10-year is slightly lower at 1.44. It's the 2-year, though. Yields are slightly higher. That flattening of the yield curve still in focus. The Brent price is currently at $71 a barrel, gains of 2%. OPEC Plus giving itself optionality as it weighs up the impacts of Omicron.
Tom, it's a positive day in terms of breadth. Looking at IMAP, this is, of course, the sector breakdown for you so far this morning. You ended with crude, so let me start there as well. With the OPEC Plus decision, helping out some of the material stocks today. You can see that this chunk is in the green. Energy also in the green as well. Not a lot of areas where you'll find bits of sell-offs. You can see there's a little bit of red in staples over here. That really seems to be it. We are ending the week after somewhat of a roller coaster ride. However, this will signify if we can hold these gains up around 0.7% so far on this broader market. If we're able to hold that, we will end the week higher. So that will help to perhaps mask some of the drama underneath. Is this a regime change? Can this last if we do get more cases, more restrictions in Europe? Well, so far, Tom, these markets able to push higher.
A couple of corporate stories are in focus for us today as well. Daimler and the board there approving $68 billion in spending. Some of it new, some of it old, for Mercedes cars and trucks to revolutionize and transform to electric vehicles. You're seeing gains of more than 1%. The critics, of course, of Daimler in the past have said they're not doing enough to catch up with the likes of Tesla, etc. In terms of Telecom Italia, you got the news out late yesterday that the government there is looking at protecting some of the more sensitive parts of this business as KKR lines up that $12.2 billion bid that broadly is welcomed by Mario Draghi and team. Allianz freeing up some capital stateside, $4.1 billion. They're facing lawsuits in the US. They do have this additional capital there on the back of the reinsurance deal that they come to stateside. Gains of 2% for Allianz. Okay, let's get your Bloomberg Business Flash with Leanne Gerrans. Leanne.
Good morning, Tom, and thank you. DD Global has begun preparations to withdraw from US stock exchanges and will start work on a Hong Kong share sale. Bloomberg reported last week that Chinese regulators had asked DD's top executives to devise a plan to delist in the US over concerns about data security. Sources say it aims to file for a Hong Kong listing around March. Now, US antitrust officials have sued to block NVIDIA's proposed $40 billion takeover of ARM, saying the deal would harm competition in the semiconductor market. The FTC says it is acting to prevent a chip company from stifling the innovation pipeline for next-generation technologies. UK-based ARM is owned by SoftBank and licenses its technology to hundreds of companies, none of which it competes with. Shell has pulled out of a controversial oil project in the North Sea. The company says the economic case for investment in the UK's Cambo oil field is not strong enough. Environmental groups have criticised the plans, saying there are odds with the UK's goal of reaching carbon neutrality by 2050. And that's your Bloomberg Business Flash. Danny.
In London there. Now to markets where European equities are opening higher, falling gains in the Asian stock market. That's, of course, as traders await a key jobs report in America that could catalyze an already hawkish move from the Fed. We also saw crude advance after OPEC Plus proceeded with an output hike, but left room for adjustments. Then we also have tech in focus this morning after DD began the process to delist from the U.S. Well, let's try to digest and work through all of that. Joining us now is Justina Lee, our markets and quant reporter. So, Justina, a busy end to a busy week, but starting off with Jobs Day, what does the setup look like into this key bit of data?
Right. I mean, right now, a Bloomberg survey of economists is showing expectations for a slight acceleration in job growth last month and a slight tick down in that unemployment data. I'll be kind of curious to see how that really moves the dial on Fed expectations, because we've had like a few officials lately kind of reinforcing Jerome Powell's message that they see room to accelerate monetary tightening. So it will be kind of interesting to see, you know, whether that really only confirms that or can kind of change that at all.
We've been talking about the tech story, of course, in terms of what's happening with the SEC, but also DD starting that delisting, a prospect that seemed untenable or at least highly unlikely at the beginning of this process. Now it's happening. A lot of concern, a lot of pressure on Chinese tech listed over in Hong Kong. How much of this is a factor that investors are going to have to weigh up going forward when they look at the likes of Alibaba and Tencent?
Right, exactly. Because in recent years, I mean, or the past decade even, we've seen a lot of investors reap profits from those tech giants that are listed in the U.S. But yesterday, we got the news that the SEC is thinking of tightening disclosure requirements, you know, before they can list in the U.S. And we've really seen a very dramatic reaction in tech shares listed in Hong Kong. But of course, this only comes after already severe underperformance over the past year. And I think this also kind of symbolizes the kind of the tense U.S.-China relations right now in terms of these matters.
Well, speaking of tense, Justina, I was reading your story from yesterday, and as always, a fantastic headline. YOLO Army gets hit by volatility as speculative stocks whipsaw. Is the YOLO Army in trouble right now?
Well, it feels that way all of this week. I mean, we've had a plunge in ARK, you know, one YOLO favorite, and meme stocks, profitless tech. And it does seem like people are getting a little bit more concerned about valuations now that it seems like bond yields are heading higher. We did see those stocks take a bit of a breather yesterday. I mean, there was a bit of a relief rally across the board. But I think it's fair to say that the outlook has changed quite a lot now that people are worried about, you know, the variant as well as the Fed at the same time.
Okay, Justina, thank you very much for kicking things off for us, giving us a preview, of course, as we look ahead to the non-farm payrolls and how that plays out for these equity markets, to what extent this is a pivotal moment now. Justina Lee, our markets and quants reporter. Coming up from jobs to inflation to the spread of Omicron, we're going to dig deeper into the markets next with BlackRock's Wei Li. And stay with the program. We're going to be joined later by the finance minister of Chile to discuss everything from COVID to the country's upcoming presidential runoff. This is Bloomberg.
think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to the Open. We are 10 minutes into the European trading day this Friday. Gains of 0.6% across the benchmark European stocks 600. Decent gains across the travel and leisure sector. Top of the sectors up 2%. Just one sector in the red as things stand. Basic resources down 0.2. Okay, the latest US jobless claims figures rose by less than forecast, and payrolls data due out later today are also expected to show a tightening labour market. All of that, of course, could strengthen the hand of the more hawkish voices on the Federal Reserve, who are becoming increasingly worried about inflation. Here's what Fed Governor Randall Charles had to say on Thursday.
I certainly would be supportive of a committee decision to move the end of the taper forward from where people had been expecting it in June.
Clouding the way forwards, of course, is the emergence of Omicron, the coronavirus variant. We've seen, of course, infection rates in New York back to very high levels as well. Let's dive into all of this with Wei Li, Global Chief Investment Strategist at BlackRock Investment Institute. Wei Li, I want to start by asking about the price action that we've seen over the last week as investors weigh up the risks of Omicron, but also a more hawkish Jay Powell. What do you think this means? Are we at a pivot moment now in terms of these equity markets?
In a way, yes, because there are all these factors that are coming to a head. But specifically in terms of how we approach investing in light of Omicron, I think the fundamental question to really address and try to answer is, does the Omicron development represent a derail of the restart story, or does it represent a delay of the restart story? Because if it is just a delay of the restart story, then less restart now means more restarts later, and it shouldn't fundamentally change our broad risk appetite. And this is our base case at the moment. So that's on Omicron. And in terms of Fed expectation, obviously a lot happening from now going into next year. But one thing I would say is that the inflation mandate has been met. Labor market is key.
Wei, good morning to you. Well, if that's the fundamental side of the story, there have been others who've suggested that a lot of what we've seen is positioning. It's been a successful year for risk assets, so this is just managers hunkering down, trying to take some of that profit as we head towards the end of the year. How much at play do you think that is behind the recent market volatility?
Absolutely, and thinning liquidity as we head into year-end certainly played a role as well. I've had a lot of conversations in recent days and weeks, and I've actually seen a wide range of interpretation of what's happening in market and what to do about markets. So on the one hand, you have managers and investors wanting to take profits to lock in a reasonably good year. On the other hand, I have clients telling me that this is Christmas coming early. This is the correction that they've been waiting for. Not much of a correction, but we have also seen some of the kind of activities coming into markets trying to take advantage of the recent volatility. So I would say a wide range of interpretations and views to play the recent pockets of volatility.
Wei, what is the pace and rate? What is the assumption that you are underpinning in terms of the pace and rate of rate hikes going forward into 2022 that underpins your more broadly bullish view?
I am so glad that you asked about the pace of a rate hike in addition to kind of the rate hike itself, because in our view, ultimately, it's the cumulative rate hike, the path that matters in addition to when the liftoff would start. So as I said earlier on, thinking about Fed's dual mandate, the inflation mandate has already been met. We have said it for almost a quarter now. And right now is really all eyes on the labor market. And here the key focus is really around participation rate, because without proportionate increase in participation rate, we could get back to unemployment level of pre-COVID levels even in Q1 next year, right? So we do expect participation rate to gradually go higher as well, and somewhere in H2 next year we would see the employment mandate being met too, and that's when we would expect the first lift off. But from there on, the path we expect to be very gradual in response to rising inflation, which distinguishes this cycle versus previous cycles, and that underpins our pro-risk view.
Well, also on the length of this hiking cycle, we've seen markets now start to price in a rate cut in December 2025. I have this up on the terminal for us on the GTV library. Does this tell you that the market is now pricing in potentially a policy error, that the Fed will have to move to cuts in just a few years?
I think the very shallow rate path and potentially further down the line having to kind of cut rate after hiking rate. We see that in the case of BOE as well. To some extent, it could kind of speak to markets pricing in policy having to reverse. What does that mean in terms of the decision around policy making? But to some extent, it very much represents the new nominal world that we're in right now, where central banks have moved their policy framework to react a lot more in a lot more muted fashion to inflationary environment in comparison with previous cycles. And this is the framework shift that we have seen in the Fed, the framework shift that we have seen in the ECB, and that actually we believe is here to stay. So market participants may not be fully appreciating how significant this shift in regime we are in right now.
Wei, really wonderful to get your thoughts. You're going to stick around with us. That's Wei Li, Global Chief Investment Strategist at BlackRock Investment Institute. Well, coming up, Didi have set the wheels in motion to delist from U.S. stock exchanges. We're going to focus on tech, the sell-off, and China next. This is Bloomberg.
India might be securing jobs for its highly skilled elite, complicated, uncertain taxes have pushed most foreign companies in need of cheap labor towards China. That's costing the economy an estimated $140 billion a year.
They've been saying they're open to the rest of the world, but, you know, there are still a lot of protectionist barriers on doing business with India.
To follow in China's footsteps and reach the government's goal of being a $5 trillion economy by 2025, India needs to create a model which succeeds both at home and abroad.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the Q3 was the quarter that was most affected.
Welcome back to the Open. We are 20 minutes into the European trading day. You're seeing some modest gains across the European markets, gains of 0.6%. Over in Italy, top of the list, up 0.9% on the FTSE MIB. Here in the UK, the FTSE 100 is gaining 0.6. US futures pointing up as well, just about 0.1% as we look ahead to these US non-farm payrolls. Okay, let's switch focus to the corporates and specifically China and China tech. Didi, the Chinese ride-hailing giant, has begun preparations to withdraw from US stock exchanges. The unprecedented move is a reversal as it yields to demands from Chinese regulators that had opposed its American listing. Sources telling us it will pursue a listing in Hong Kong, aiming to file at around March of next year. Joining us now from Hong Kong is our chief China markets correspondent, Sophia Horta-Acosta. Sophia, what do we know then at this stage about Didi's delisting, and how much of a surprise has it come to the investment community?
So, morning, Tom. If you pull up Didi's release from this morning, it actually is just 3 sentences and just over 100 words, not really, really thin on details. What we do know is that this is a process that Didi had been asked to prepare. Bloomberg reported that last week, to prepare that delisting. This is, of course, a company that went ahead with a share sale in the US despite reservations from the cyberspace regulator in Beijing, asking it to wait for a cybersecurity review. And Didi went ahead anyway. We know that it was the second biggest IPO of a Chinese company in US exchanges, behind only Alibaba. So a lot of US money invested in there. Now the convertibility to Hong Kong should be relatively straightforward, of course, if Didi does go ahead with a listing here, because Hong Kong, as we know, has a pegged currency that is pegged to the greenback, and also the company is saying that it will ensure full convertibility. But then again, you know, Didi is a constituent of the MSCI China Index, so we could see some passive selling pressure there. And also some American fund mandates may not be allowed to hold shares in Hong Kong. So that really complicates the picture as well. And if you think about how Hong Kong's stock market has done this year, Tom, it's one of the world's worst performing indexes this year, and PE's valuations are really low. So do you really want to own a Hong Kong listed Chinese tech stock? That's another question for investors.
Sophia, you mentioned the vast amounts of American money that are holding Didi shares. For those who are holding Didi's ADRs, what happens to them?
So it's really kind of fuzzy. This is in many ways unprecedented, as Tom said in the intro. If you look at what happened to some of the previous examples where Chinese companies with primary listings in New York, they then kind of sell. They start a secondary listing in, say, Hong Kong, typically smaller than the primary listing, and then slowly shift most of the liquidity to the secondary listing. That's a practice that many companies have done, not just here, but in Europe as well. So if you're holding that and you're based in the US, you have to, of course, make sure that as a fund, your mandate allows you to own Hong Kong listed shares. And also the convertibility of that, this is a process that could take a long time. And of course, Danny, it's not guaranteed that Didi will actually be able to pull off a Hong Kong IPO. We don't know whether investor demand will be there for a company that's still facing a lot of regulatory challenges. This is not just on the stock side. Didi is very much in focus in Beijing because of its business practices. So who is going to buy those shares, and will the IPO be successful in Hong Kong?
Okay, Chief China Markets Correspondent Sophia Horta-Acosta in Hong Kong on these plans for Didi to delist its ADR. Still with us is Wei Li, Global Chief Investment Strategist at BlackRock Investment Institute. Wei Li, just picking up from this story, How challenging is it for you and the team at BlackRock now to make the argument that you need increased exposure to Chinese markets when we seem to see and are witnessing a greater decoupling of these two major financial sectors?
Well, the DD delisting headline is certainly indicative of the tension, especially the tension in technology between the two superpowers in the world. And also more broadly, there is that longer-term hawkish policy kind of pivot in China on greater social objectives towards greater social objectives, which we have been flagging. The reason for us to be modestly constructive on the Chinese market on a tactical basis at this point is really around the thesis that growth is deteriorating into the year end, heading into next year. And next year is a politically significant year for China, not least because of the National Party Congress, not least because of the Winter Olympics. And we do believe that they cannot let growth fall through the floor, what is acceptable. And as a result of that, we actually expect policy to be incrementally easier on the monetary front, on the fiscal front, and even the regulatory pressure. It will stay, but would it intensify going into next year? That's a question mark, and that's why we're constructive modesty on China assets at this point.
Wait, quickly here, how receptive are investors to that message? Given in other words, how small are allocations do you see to China?
The starting allocation for global portfolios towards China is very small in comparison with index benchmark, and also in comparison with what we think is kind of a fair representation in a diversified portfolio, considering the diversification benefit that China assets bring to portfolios, and also considering the growth potential for China assets. So from a longer term perspective, given the very, very low starting point of global portfolios to China, the incremental direction is constructive in our view.
Okay, Wei Li on the need for additional exposure to the Chinese market despite these ongoing tensions. Global Chief Investment Strategist at BlackRock Investment Institute. Thank you. Have a great weekend. Coming up, we're going to be speaking to Chile's Finance Minister, Rodrigo Cerda, with a polarizing presidential runoff just around the corner. Stay with us. This is Bloomberg.
The antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
I think what we've seen during this period of time is that communicating via video is not a fad. That we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to The Open. We're 30 minutes into the European trading day. Here are your top stories. It's jobs day. Traders watch for any clues on the prospect of a faster taper from the Fed. DD delisting. The ride-hailing giant begins plans to withdraw from U.S. exchanges. We'll bring you that Bloomberg scoop. Plus, NVIDIA's plans to become king of the chips hits the rocks. The FTC sues to block its $40 billion acquisition of ARM. Tom, a mildly more positive day in equities, and not to be a negative Nancy, I can't help but wonder whether this is conviction or just waiting around until jobs day.
Well, there's so much volatility out there. We've seen that reflected in the US markets. China, there's concern, of course, about the ongoing changes around technology and DD listing. But it is that look ahead, as Danny says, of course, to that non-farms payroll number, where the surveys are suggesting you're going to get a print of 550,000 for November. If you do get that number, it's unlikely, it seems, that Fed officials would change as they look to speed up the taper and arguably pull forward those rate hike expectations. The European stocks currently gaining 30 minutes into the session, of course, at 0.3% this Friday. Over in Germany, 0.5 is the gain that you're looking at as government officials there consider and ramp up the restrictions to try and curb the virus spread. In France, you're seeing gains of 32 points, and here in the UK, gains of 24.3%. Let's see how things are playing out sector by sector. The last time I looked, travel and leisure, top of the list, and there it is, gains of 2%. At the bottom of the list, you're seeing losses for basic resources of 0.3%. Oil, by the way, is, of course, still in focus for us. That decision by OPEC Plus to continue with its output curbs, despite the fact, of course, but also giving itself optionality as it weighs up the impacts of Omicron. Danny.
All right, Tom, well, let's focus on Chile now. In just over 2 weeks, Chile goes to the polls for a presidential runoff race. On one side is the frontrunner, Gabriel Boric, who's pushing for higher taxes and greater equality. On the other is free marketer Jose Antonio Cast. Growth in one of Latin America's richest nations is expected to reach a stellar 11% this year, helped by cash transfers and a robust vaccination campaign. But some analysts warn that rising interest rates and political uncertainty could throw the economy into reverse. Well, let's have this conversation now with our next guest, Rodrigo Cerda, who is Chile's finance minister. He was appointed in January. And before that, he was head of the budget office. Mr. Cerda is an economist with a doctorate from the University of Chicago, and he joins Tom and me now from Santiago. Minister, thank you so much for joining us this morning. Really appreciate it. So I want to start first with the election. Two very different candidates and two perhaps very different polar outcomes. What are you hearing from investors in terms of their concern and investing in Chile during this somewhat politically contentious time?
Hello, Danny. Hello, Tom. Well, thank you for the interview. Yes, as you said, we'll have our election, our second round election in 2 more weeks. But I think that one of the things that we need to highlight is that we already have election on the Congress, and the result was quite a moderate election in the sense that we have now in the Senate 2 large blocks. Almost 50% of the Senate will be for the right or center right, and the next 50% will be for the left and the leftist sector. And in that sense, I think what we are going to see more in the future, which is different to what we have seen during these last 4 years, is that in the future probably we'll need much more political agreement. And in that sense, probably we're going to see much more moderation in our discussion, in our political discussion, and also more, if we are going to make some changes, probably those changes will be more gradual. And in that sense, I think we're going back to what we were more the way we did things in Chile. That was that we were making changes, social changes, but very gradual. And in that sense, and also using the fiscal responsibility, which is very important for us. So in that sense, the next...
So you see...
Yes.
So you see moderation in politics, because there's been a lot of concern, a lot of talk about the increased political uncertainty in Chile. Is that exaggerated?
Yes, Tom, I think that what we just saw, I mean, the result of the last election on the Congress, which was 2 weeks ago, well, it was a result in which people said that they wanted more moderation, in the sense that now we have two big coalitions, and those two big coalitions will have almost half of the Senate each. In that sense, if we need to make some changes in the future, well, we will require a lot of political agreement. So even though we have seen some polarization on the discussion in the last 2 years, and this is because we have two very large shocks or events in Chile. In one hand, in October 2019, we have a larger protest and social unrest on our streets, and then we have the pandemic, as is the rest of the world. Those are two events that make big changes in our society and in the way we used to discuss the political arena in Chile. But now I think things are becoming more calm, and in that sense, I think we are going to see more moderation in discussion.
So, Minister, then we're just over 10 days away from the election. Before we move on from this topic, I'd like to get your thoughts. What do you think will be the outcome between this runoff of Boric and Cast?
Well, I mean, this is a very tight election, and this is the usual, the election in Chile. This is a second round election. We have one candidate which is from the left and one from the right. Now I think some way a little more polarization, but also what I'm seeing now is that in the second round election, well, both sides are trying to make some movement to the center, in the sense that they are making change to the programs, and they're trying to move and to have more votes from the center, which is also a very good news for our economy, because in that sense, and for our society, because it's quite similar to what happened in the Senate. So people, and in that case, candidates, are looking for the center votes, and in this case, also we are looking for more moderation in the upcoming weeks before the elections.
Okay, and on the economy, there are forecasts of growth of up to 11% this year for Chile's economy. A lot of that, of course, down to the stimulus and the measures put in place by you and your team to support the economy during this pandemic. But then there are also those who predict a recession potentially next year. Is that in line with your forecasts?
No, not really. I mean, that's correct. What you already said, in the sense that during this year we'll be growing very fast. In fact, what we're looking, I mean, when we make our decision in terms of having a very large fiscal impulse during this year, which is around 10 points of GDP, which is very large, but we require this impulse because, as we were discussing, we have a lot of people under the pandemic that were under lockdown, and we need to make them not to have uncertainty in terms of their incomes. So this large fiscal impulses provide them today with a larger recovery of the economy, which is a faster recovery. But of course, next year we're going to normalize our fiscal policy, and in that sense, probably we're going to be growing between 3 to 4%. But even though I think 3 to 4%,
so 3 to 4% is what you're targeting, what you're looking at next year. Are you confident you can rule out a recession then?
I think we have at least two engines of growth in during next year. On one hand, we still have a lot of liquidity for households that we expect that during next year. And in that sense, probably we still have some impulse on consumption. And another engine of growth is that in our budget, we have a larger public investment for next year. So in that sense, we expect to have investment and then consumption, which probably will provide us with growth during the next year.
Well, Mr. Cerda, one of the cases for a potential a recession next year is made by JP Morgan. Not only do they see that, but they see less support to the economy. Specifically, they're saying that a bill allowing a fourth round of early pension withdrawal, something Chile has done to put more cash into the system, that it is unlikely to pass. What are your expectations?
Well, you know, I mean, we have during this week the discussion of Chile Day in the UK, which is a big conference on Chile. I couldn't be able to fly to the UK because I stayed here to discuss the forced withdrawal of the pension funds in the Congress. And we expect that this law, which is going to be voted today in Congress, we expect that it doesn't advance and it finances. We don't have this forced withdrawal of the pension fund because we think that there's already too much liquidity in the economy and no more liquidity is needed. In addition, we have all the transfer from the government to households that has been made during this year. That's around $25 billion, which is around 8 to 9 points of GDP, as I already said. So in that sense, I think we already have a lot of liquidity, a lot of impulse for the economy during next year, and we need to start thinking more on the medium term in terms of pensions. And in that sense, to have pensions, well, we need to remain the pension funds in the individual account of people. So that's one of the things we're discussing today.
So how are you and the team thinking about a tighter Fed policy and the impacts on economies like Chile's?
Well, of course, this is one of the risks we are seeing, but also we know that in the United States they are making also some impulse in terms of infrastructure, and in that sense, well, we expect that for Chile at least, we still may have some impulse from outside our economy. And in that sense, what we require now is that we start with the normalization of the fiscal policy and also of monetary policy, but we expect that this is going to be more gradual to provide some space to grow during next year.
Okay, thank you, sir, so much for your time. That was Rodrigo Cerda, Chile's finance minister, on the outlook for that economy and the politics as the country heads towards a presidential vote come December 19th. Okay, coming up, Germany imposes nationwide restrictions on the unvaccinated in an effort to boost inoculations as the Omicron variant spreads. The details and that story is next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 45 minutes into the European trading day. Stocks here in Europe pairing some of the earlier gains, just eking out gains of a little under 0.2%, 1/10 now. Futures in the US pointing lower. One stock to mention is Dassault Aviation, gaining 4.8% as I'm looking at it on the back of this line crossing from the Elysee in Paris. President Macron signing a deal to sell 80 Rafale jets to the UAE, so a boost for that stock. Okay, switching focus from France to Germany, and that country has imposed strict nationwide curbs on the unvaccinated in an effort to boost inoculations. Adding to the clampdown, officials also backed a plan for mandatory vaccinations, which is set for an imminent vote in the Bundestag. For more, let's go to our Europe correspondent, Maria Tadeo. Maria, significant restrictions then coming through for Germany. I guess the key question is, will it work?
Well, Tom, these are sweeping restrictions that are coming in the country and also a big political U-turn from the German government. So if you break it down, there's two elements here. One, of course, is that if you're unvaccinated, then essentially you can kiss goodbye to your social life. You know, that is what it comes down to. You know, you're not going to be able to go to a museum. You're not going to be able to go out for dinner. You're not going to be able to have normal social outings. And then the other one, of course, has to do with the vaccination mandate. The German government now suggesting that this should be put to a vote. Of course, we're waiting for Olaf Scholz to be sworn in, but that should be done before the end of the year. And you could see this mandate already operational from the start of 2022. Now, this is a U-turn, as I said, from the German government, which initially said, and I'm sure you remember this very well, this is a personal choice. The government was never going to force anyone to do this. But Tom, in many ways, what it reflects is that this is a wave of no-vax unvaccinated people who simply don't believe in the vaccine and who are not going to listen to government. So this is the last resort. Now, to answer your question, will it work? When you look at countries like Austria, but also the French would introduce this health path, it really does, because at one point the positive incentives are no longer working. The problem here, and this is always the perennial question, is what type of social pushback are we going to see, particularly to a government that is just born? Olaf Scholz is not tested in this position yet. Well, abandoning the carrot for the stick. Maria, thanks so much. That's Bloomberg's Maria Tadeo. Now, let's continue the story on Europe. We're joined now by Silvia Ardagna, head of European Economics Research at Barclays. Silvia, thanks so much for joining us this morning. Maria was just laying out for us some of the restrictions and indeed some mobility restrictions going into place in Europe as cases rise, as the new variant spreads. What, in your estimate, will be the impact on the economy if we continue to see these types of restrictions in Europe?
Good morning, and thanks for having me here. Look, it is not easy to assess the impact right now because obviously will depend on how much this variant is or is not affected by vaccines. Now, what we compare it to, for example, is what happened at the beginning of last year. It's a sort of like worst possible case scenarios. Back then, we had a very low fraction of the population that had 2 vaccine shots in Europe, and we had a decline in quarterly growth rate for 2 consecutive quarters of about 0.4%. Now, if this Omicron variant instead is still, if vaccines are still effective, as it seems to be to some degree, the impact clearly could be much less than this. So far, we are expecting a decline in our growth forecast from Q3, which was extremely strong, to Q4 and Q1. But we see the spread of the variant and these containing measures more as a downside risks rather than we have not embedded them yet into our central forecasts.
Silvia, good morning. How do you think this is playing into the thinking of the ECB? Christine Lagarde is coming out in the last few minutes saying it's not going to change the plans to end the PEPP, Emergency Purchase Program, in March. Are they going to have to rethink things after that, though, as they reassess the drag on the economy?
Look, our own base case is similar to the ECB. We think the PEP will terminate in March in a baseline case where containment measures remain more targeted to the unvaccinated. But we also think that the ECB will provide more accommodation via the standard APP program. So we think that will be scaled up. It seems to us that the message has been consistent across governing council members that we need to avoid the cliff effect from the end of PEP. And second, that although inflation is clearly high and higher than the ECB mandate, it's temporary. And the medium-term inflation that the ECB looked at will likely to be below 2%. That's our forecast. And I think the communication on this point has been quite consistent from the ECB so far.
Yeah. Lagarde as well saying won't hesitate to act once rate hike conditions are met. Then, Sylvia, is the potential policy error that the ECB acts too quickly, if in your estimate, staying steady at the moment is the way forward?
According to our baseline forecast that the ECB provides more accommodation through the APP, there is not going to be any policy error. If we were to be wrong and the ECB were to terminate PEPP and not scale up APP, then I would, based on our macro forecast and assessment of the tightening of financing conditions that could generate, then yes, there would be some premature removal of withdrawal of monetary accommodation.
Okay, Sylvia Adania, Head of European Economics Research at Barclays, thank you for giving us your take on the implications of Omicron and the impacts, of course, across the European economy, and in light of those comments from the ECB's Lagarde. Coming up, we hear from the co-founder of Grab Holdings, Southeast Asia's largest ride-hailing and delivery company, at least one of. That is next. This is Bloomberg.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
We chose the path that enabled us to get to the most important objective first, which is to get the best investors for our day one cap table. And with that, based on our PIPE investors that were attracted to the long-term growth opportunities that we've seen, and the very low redemption rates that happened during the de-SPAC process, we are actually extremely happy with the outcomes that we've achieved as well.
You've turned Grab into a super app, including delivery, payments, but also, of course, ride-hailing. How worried are you about a resurgence of COVID and Omicron right now?
So I think a critical part of Grab's growth trajectory over the last 2 years has been our super app strategy that has enabled us to be very resilient to the COVID challenges. To share a bit more about what it is, think about Grab as Uber, DoorDash, and Venmo all in one. Now, from the day when it starts, when you wake up all the way when you go to bed, you're able to get your breakfast, pay for meals, send your friend gifts, buy groceries, and more. And why that is really important is because it enabled us to have things like shared fleet strategies with our largest driver partner network in the region, which enables our drivers with their super apps to decide if they want to transport people, deliver food or groceries seamlessly in the app, and therefore enabled us to very quickly pivot from mobility to deliveries over the last 2 years. Now, with this super app strategy, we're very confident that we can continue to serve the needs of Southeast Asia's users and our partners, despite whatever challenges COVID continues to throw at us.
Grab's co-founder there speaking with our Emily Chang. And the Southeast Asian app dropped 21% in New York after completing the biggest SPAC merger ever, Tom.
Yeah, and sticking with technology, antitrust officials are suing, these are in the US, to block NVIDIA's $40 billion takeover of ARM. It's not a major surprise, but what they're saying, officials in the US, is they're concerned about what this will do for innovation. Of course, ARM licenses its technology to many of NVIDIA's competitors, Qualcomm, amongst others, IBM. They've been very concerned and lobbying hard against this deal.
Yeah, I mean, it's really fascinating to see that many analysts, many investors didn't think this would go through anyway, and they didn't need it to go through. NVIDIA's done well. Tom, I also just want to mention, as Lagarde speaking, she's saying it's very unlikely the ECB will raise interest rates in 2022. She has been saying that if conditions are met, she will indeed raise them, so clearly not happening for next year. Well, that's it for the European Market Open. Surveillance Early Edition is up next. You're not gone with me yet. I'm sticking around. This is Bloomberg.
An extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
The word transitory, I think it's probably a good time to retire that word.
If we get to next spring and inflation is still over 4%, the Fed would have to say seriously, this has run too high for too long.
Anything that purchases in the first, quarter or maybe early in the second quarter, right now, I would support that.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. It's Jobs Day. Today's U.S. payrolls could shape views on Fed policy. Randy Quarles becomes the latest to express a hawkish pivot at the central bank. Lagarde won't hesitate. The ECB president says she will hike rates once the conditions are met. That's unlikely to be in 2022. And stay with Bloomberg Surveillance Early Edition this hour. We're going to be speaking to the BIS head of innovation and former ECB executive board member, Benoit Corey. Send in your questions on IB plus TV Go. Let's first check in on these markets as we wrap up the week. Happy Friday to you. You made it towards the weekend. A lot of volatility throughout this week, but a little bit more calm in these markets. European equities up 0.1%. They were up higher to start the morning at the open, so starting to give back some of that. Travel and leisure, the best performing sector, up 1.5%. Again, despite some concerns about mobility restrictions. Now, you really do have to wonder whether some of the positive mood music here, we have a stronger dollar as well, up 0.2%, is because of a more positive outlook, or if we're just simply holding tight before today's U.S. jobs data. 550,000 is the estimate. Will it spur a hawkish Fed to be even more hawkish if we get a surprise to the upside? Here's Brent crude up about 2.6%. This follows OPEC that decided not to pause in terms of its planned increase in output. It went ahead with that, surprising many, but left the room open to take that back, to walk that back, a caveat in their decision, so that perhaps allowing oil to move higher. Well, let's get your look as well in terms of what Europe is doing, some of the pre-market action as well. So here's your European map. We're looking mostly green across the board, a little bit of unchanged in some areas. Your FTSE 100 up just about 0.1%. Some of the oil majors might be doing a little bit better as well. I also do want to get a pre-market check for you on DD as well, because they are going through the process of delisting in the U.S., moving to China, moving to Hong Kong, and of course for ADR holders in DD, this is a big question mark with what happens to them. We are seeing DD shares rise 9%, starting to come down as we get further. Of course, this just opened pre-market, so we might get some volatility there. But again, DD backing off of their U.S. listing, we're now seeing shares rising more than 8.5% pre-market. Now, the mood at the Federal Reserve appears to be getting more hawkish. This week, Jerome Powell said that officials should consider speeding up the tapering of bond buying. And on inflation, the Fed chair also decided to ditch the word transitory.
The word transitory has different meanings to different people. I think it's probably a good time to retire that word. The economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner.
Now, more Fed officials have added their voices to Powell's message. That includes Cleveland Fed President and the outgoing Federal Reserve Governor Randy Quarles. Both of them support a quicker taper.
Going into the September meeting, I thought there was a strong case for tapering at a faster pace than what we had actually announced. And since that time, the data have come in supportive of that case. So I'm very open to considering a faster pace of tapering.
I certainly would be supportive of a committee decision to move the end of the taper forward from where people had been expecting it in June.
Pleased to say we're joined now by Sweta Ramachandran, investment manager at GAM's European equity team, and of course by our markets reporter, Justina Lee, as well. Sweta, I want to get into the conversation, your expectations, but Justina, let me first start with you. And can you just sort of set the scene for us in terms of expectations in this market right now for the jobs report later today?
Right. I mean, a Bloomberg survey of economists is indicating expectations that jobs growth kind of accelerate a little bit to, over 500,000 last month, and the unemployment rate is going to fall just a little bit. And I think it'll be interesting to see how this will move the dial on Fed expectations, because as you mentioned earlier, we've had some pretty clear signals lately that they're thinking about accelerating monetary tightening because it seems like they're more focused on fighting inflation right now.
Well, let me take that to you then, Sweta. So how could this impact Fed and Fed actions?
Well, absolutely. I think the issue with employment has not been necessarily demand for labor, but supply of it. So I think clearly if we see a good jobs data today, in addition to that, we also see pressures building for wage inflation, which is increasingly dominating the inflation narrative, which is why I think Chairman Powell decided to retire the use of the word transitory, given that that is likely to be more permanent than transitory.
I mean, we did see a story, for example, overnight, a Bloomberg scoop that Exxon isn't going to pay its employees to keep up with inflation. I wonder whether this is an isolated incident or if it perhaps signals that, okay, a wage price spiral, that's not where we're heading.
I do wonder if that's a bit of an isolated incident because everything we're hearing from the rest of the economy, particularly industries like hospitality and leisure, which are suffering the most, suggests that they are paying over the odds at this time. This is across economies in Western Europe, in the UK, as well as in the US, where they're struggling to find workers. So I do believe that wage inflation is likely to stay here for longer.
And Justina, as we wait for the data and as we wait for the question mark of how this impacts the Fed, how volatile have markets begun to grow?
Right. I mean, we did see U.S. stocks stage a bit of a relief rally yesterday, but I think the last time I checked, the futures are kind of giving up those gains today. And I think, we have to think about what a big change this is for markets, because especially since lockdown started, I mean, markets have been awash with liquidity, and that's why we've seen all those crazy gains in big tech stocks over the years. So if we're thinking about, focusing on higher inflation, possibly higher rates next year in the U.S., I think that will really kind of change, stock leadership in the U.S.
Sweta, how different of an environment are we in now? Is this a regime shift that we've witnessed, considering what's happened at the Fed, what's happened to Jay Powell's language?
We have seen a little bit of a head fake in terms of this regime shift since the start of the year, with value, for instance, giving up some of its gains. However, it does seem clear that the market's tolerance for these long duration, long growth stories is being tested as discount rates start to go up, as the rate hike narrative comes closer to us. So I do think we will start to see much more polarization between companies that generate cash, that are profitable today, versus those that are promising jam tomorrow.
I have to say, Sweta, one thing that I loved in your research that really stuck out to me was the difference between now that you write of March 2020 and this moment. You talk about the commitment to tapering and the higher valuations. Does that set us up for a potentially dangerous market? Because March 2020, it wasn't exactly a pretty period.
Yeah, absolutely. I don't know if I would say dangerous, or perhaps we should expect more volatility, which is a right opportunity for stock pickers to, and I think, this rising tide shifting all boats narrative that we have seen year to date, that is likely to reverse. So it's much more likely to be a stock picker's environment where some stocks that are overvalued for the amount of cash and profits that they generate are likely to be more severely punished than those with stronger balance sheets that can withstand a higher rate environment.
Justina, what about if you're a quant and you're picking factors? What seems to be the outperformer for this environment heading forward?
Yeah, I mean, as Sweta mentioned earlier, we've kind of been disappointed with a few value rotations this year. But the factor is kind of making another comeback lately. And I think a lot of analysts are saying that if we do see higher inflation and higher bond yields, this really sets up a way better environment for value, especially since the valuation spreads within the market are still pretty wide, which means, value is as cheap as it's ever been, or at least since the dot-com era.
Justina, thank you very much. That's our reporter, markets reporter there, Justina Lee, and Sweta Ramachandran, who's going to stick with us as well from GAM, of course. Now, smart conversations continue on Bloomberg Surveillance Early Edition this hour. We're going to be speaking to the BIS head of innovation and former ECB executive board member, Benoit Corey. But up next, we're going to continue the conversation around jobs, around markets, around inflation in Europe as well. Sweta Ramachandran stays with us. Send in your questions on IB plus TV Go. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Well, we just had some final numbers for Europe PMI readings coming through. We saw the Euro area November services PMI missing the preliminary number, coming in at just below 56. Similar case when it comes to both Germany and France. Somewhat unusual for final readings. Some big major revisions to the downside. So let's dig further into the European equity story. Sweta Ramachandran from GAM is still with us. So perhaps some concerns about the economy if we're getting some revisions, but otherwise stronger growth. Where do you want to be invested in Europe at this moment?
Yeah, I think it's a really interesting setup for Europe, considering the undervaluation that it trades at relative to the U.S. market. That has somewhat been correcting, but Omicron really threw that spanner into the works a little bit. Right. But what we're seeing is that heading into the end of the year, European companies are expected to report record cash flows. They've done a lot of hard work to right-size their cost base during the pandemic, and I think that sets them up either to grow organically, to invest more in growth into the next year through the CapEx cycle. So companies like the miners or the semiconductor names are quite interesting. Obviously, Europe is at the forefront of decarbonization, so that again is a potential investment opportunity. Europe is also home to some great brands that are exposed to global growth that have strong pricing power. And I think that's really where I'd want to be in a time of rising inflation, is to protect myself with companies with high gross margins and strong pricing power.
Yeah, you talked a little bit about this, but I'd love to dig into it with more detail about the cash that these companies have and what they do with it. You mentioned investments, you mentioned CapEx, but previously we have seen a lot of companies just put that cash to work with paying investors back. What do you think that mix will look like?
So clearly, I mean, I think buybacks will step up in the next year because a lot of companies are sitting on record cash piles. M&A is at a record high in Europe this year. That said, the paucity of targets possibly into the next year, a lot of them are being snapped up by private equity. If we just look at the UK equity market, where we've seen a number of bids this year, it's likely that they will start to return some of this surplus cash to shareholders, either through dividends or buybacks. My bet would be a combination of the two.
And when we were just talking about the U.S. markets, you did mention it's a stock picker's market. I wonder if the same holds true with Europe in your approach to how active you are versus holding the index.
Yes, absolutely. I would say even more in Europe, where the concentration in the index is much lower than, say, for the S&P 500 or in the U.S. markets, where tech is now such a big component of the market overall. We don't necessarily have that dominance here. So there's a lot of intra-sector stock picking opportunities where there's a lot of not all of these sectors are correlated with each other, which make them quite attractive.
Well, one sector that's been particularly volatile are airlines, as we worry about these kinds of mobility restrictions. Is that a sector that you'd want to play in right now?
I think there's definitely a mean reversion argument to play in certain airlines because they are, I mean, structurally, this is an industry that's quite capital intensive. Over the cycle, you struggle to see them generate returns above their cost of capital. However, there are certain investment opportunities in the low-cost carriers, for instance, such as Ryanair, which could benefit from this mean reversion play. Certainly, there's a strong pent-up appetite for travel. We see the strong recovery in the U.S. hotel names, for instance, Hilton and Marriott, which did quite well yesterday. That does suggest that people have a burning desire for travel, but that's being complicated right now with the ever-changing regulations.
Right, and just the asterisk of Omicron really hovers over everything. What are you waiting for to say this changes my investment thesis?
I would say it's similar to a little bit like Delta, which is why I've been a bit surprised by this quite knee-jerk reaction to Omicron, because we did get through Delta. We found that the vaccines, although less effective, did work. And in fact, the issue right now for Europe is much less Omicron and much more the wave that's been caused by the Delta variant because of the low levels of vaccination in many countries. So I would say that we still need to wait and see possibly for the evidence of virulence of this particular variant, as well as the efficacy of antiviral medications that we have at our disposal now that we didn't a year and a half ago. So I would say overall, we're much better placed to fight this variant than we were 18 months ago.
Well, surely, as well, the ECB also has their eye on it. And Christine Lagarde was speaking just moments ago saying that it's very unlikely to get rate hikes in 2022, that she will hike once the conditions are right, but those haven't been met yet. How reliable is that narrative that we won't have interest rates push higher in Europe and potentially derail some of the equity rally?
So I think this is a key differentiator between Europe and the U.S., is that the U.S. is very firmly committed to tapering and possibly a path of rate hikes starting as early as 2022. In Europe, we're seeing the evidence for wage inflation right now is more muted than in the U.S. I do expect it will follow, but that it will lag the U.S. market by some time, given we're still in the midst of this fourth wave in many of these countries. That said, I do think we can take the ECB's word, which is that they are committed not to increasing rates until we have seen an increase or a return to fuller employment than we are at today.
So if I can just throw another risk at you, I mean, I hate to sort of be the pessimistic one here, but China continues to come up as well. DD delisting from the U.S., so U.S.-China relations a concern. But I'm wondering, when you look at companies in Europe with exposure to China, be it luxury goods or otherwise, how do you approach them at a moment where it's not just geopolitical, but it's also growth concerns emanating from China?
Yeah, absolutely. We're very positive on companies that are exposed to the growth of the middle class, and we believe what the Chinese government is trying to do, which is to expand the size of the middle class, is exactly in line with the exposure of these companies that are exposed to the growth of the middle class in China. So as long as that continues apace, I think what more than the macro picture in China, we're much more focused on consumer confidence and the growth of that middle class. And as long as that continues, the structural tailwind for European companies exposed to Chinese growth remains.
Sweta, so fantastic also, not only to have you with us, but to end the week on a little bit of optimism. Really wonderful to have you with us. Again, that's Sweta Ramachandran, investment manager in GAM's European equity team. And of course, enjoy the rest of your weekend as well. Now, coming up, we're going to stick with the European story. Germany imposing nationwide restrictions on the unvaccinated in an effort to boost inoculations as the Omicron variant spreads. That story next. This is Bloomberg.
world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Nobody knows, how long the temporary effect will be and what is the long term.
Market that over the past 2 weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny, and happy Friday. OPEC Plus will proceed with its scheduled oil production hike. The group agreed to add 400,000 barrels a day of crude to global markets back in January. That should please nations, including the U.S., worried about high prices. However, the cartel also left the door open to changing the plan at a short notice. That unusual step underscores risks from the pandemic and a U.S.-led release of emergency stockpiles. The 100 new COVID-19 cases, the most since January, with dozens of hospitals now nearing capacity. New York Mayor Bill de Blasio says New Yorkers should assume the Omicron variant is spreading in the city. A visitor from Minnesota who attended a crowded convention last month has now tested positive for the variant. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much, and happy Friday to you as well. Now, Germany has imposed strict nationwide curbs on the unvaccinated. It's an effort to boost inoculations. Adding to the clampdown, officials also backed a plan for mandatory vaccines, which is set for an imminent vote in Parliament. For more, let's go to European correspondent Maria Tadeo. So, Maria, we have these big restrictions coming in Germany. Will this work?
Well, Danny, that is a big question, but the intention here really matters. You're seeing the German government U-turning on its big policy that vaccination is a personal choice. There is no government mandate. The government is now saying we need it because the vaccination rate is flat. We're expecting this vote to happen by the end of the year, so this mandate could be operational by the start of 2022. The other thing that's happening here, of course, which goes after the unvaccinated group, is to essentially shut them off from many of the social outings in normal life that you would expect. You want to go to the cinema, you want to go out for dinner, you want to, go to the museum. Well, that's not going to happen anymore unless you're vaccinated from now until the end of the year and before that mandate kicks in. Again, these are very drastic sweep-in measures, but it does show that there is almost this realization in the German government that they're dealing with a group of Novaks that simply won't get the vaccine on positive incentives. We've seen the limits and the limitations of positive incentives, and now they're going, of course, with a mandate.
Maria, thank you so much for staying on top of this evolving story for us. That's Bloomberg's Maria Tadeo. Let's also get a check in on DD share price at the moment. Of course, pre-market share price for the U.S. This follows DD planning their U.S. delisting and, in turn, a Hong Kong share sale plan. We're looking at shares rising as much as 10%. So, of course, this is pre-market for their ADRs. It's pursuing this listing in Hong Kong. The idea here is to ensure that the U.S. stock will be convertible into freely tradable shares. This, of course, on another internationally recognized stock exchange. That's the statement that they put out. So I guess the hope here is that if you're holding DD shares, you will also get the equivalent on Hong Kong. So perhaps that alleviates some concerns. Well, here's the rest of the picture for you as we go further about an hour and a half into this cash equity trading here in Europe. You're looking at gains of 0.2%. That's slightly lower than where we had opened. And one of the best performing sectors is travel and leisure as well. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Up next, we're going to speak to the BIS Head of Innovation and former ECB Executive Board member. That's Benoit Corey. That's next. This is Bloomberg.
Years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops, tanks, guns, UAVs. Clearly, neither side are taking any chances.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time that
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's Jobs Day. Today's U.S. payrolls could shape views on Fed policy. Randy Quarles becomes the latest to express a hawkish pivot at the central bank. delisting, the ride-hailing giant begins plans to withdraw from U.S. exchanges. We'll bring you that Bloomberg scoop. And stay with Bloomberg Surveillance Early Edition. This hour, we will be speaking to the BIS Head of Innovation and former ECB Executive Board member, Benoit Corey. Send in your questions as at IB plus TV Go. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Happy Friday, happy Jobs Day. Let's check in on the markets ahead of this Payrolls Friday. We're looking at positive action for the most part to round up the week in your European equity markets, up 0.2%. That's, of course, following declines of 1% yesterday and a very volatile, to put it mildly, week so far this week, as you have concerns about central banks, you have concerns about new variants as stocks are already richly priced. We're also looking at a euro, which is declining versus the dollar. This is bucking the trend of much of this week when we saw a stronger euro, but we're getting lines from Christine Lagarde talking about 2022 rate hikes not in the picture for her at this moment. She says it's unlikely, but she will act once conditions are met. Brent crude also stronger this morning, up more than 3%. OPEC, they did go ahead with their planned increases. However, they left the door open to change, especially if there are any changes when it comes to the variant as well. We're also looking at a DD share price in the U.S. pre-market that's rallying as much as 10% as well. It is delisting in the U.S. It is moving to Hong Kong. Investors pre-market bidding up that stock, which will soon disappear from the U.S. stock market. Now, let's stick with the Fed, with that story. And the mood at the Federal Reserve does appear to be getting more hawkish. This week, Jerome Powell said officials should consider speeding up the taper of bond buying. And on inflation, the Fed chair also decided to ditch the word transitory.
The word transitory has different meanings to different people. I think it's probably a good time to retire that word. The economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner.
Now, more Fed officials have added their voices to Powell's message. That includes Cleveland Fed President and the outgoing Federal Reserve Governor, Randy Quarles. Both of them support a quicker tapering.
Going into the September meeting, I thought there was a strong case for tapering at a faster pace than what we had actually announced. And since that time, the data have come in supportive of that case. So I'm very open to considering a faster pace of tapering.
I certainly would be supportive of a committee decision to move the end of the taper forward from where people had been expecting it in June.
So is the Fed leading the way for other central banks to tighten monetary policy as inflation rises globally, or are they already behind the curve? Well, we have a lot to discuss with our next guest. It's Benoit Corey, who's an economist. He's currently the head of the Innovation Hub at the Bank for International Settlements, which provides financial services to central banks. In his previous role, he was a member of the management board at the European Central Bank. And before that, he was chief economist at the French Treasury Department. He joins us now from Basel in Switzerland. Mr. Corey, thanks so much for joining us this morning. Happy Friday to you. A lot to discuss, including some of the plans, some of the partnerships you have with the Fed. But I do want to start first on this point of inflation when it comes to the Fed and the ECB. With the Fed starting to tighten policy, does the ECB risk being behind the curve?
Well, good morning, and thank you for having me this morning. Well, I'm not going to comment on the on what the ECB has to do. They certainly know better than I do. But it's true that this we're facing a new shock, the Omicron shock, and this comes at a time where the global economy is really caught between a rock and a hard place, with possibly lower demand chasing higher supply restrictions, and the big question mark for central banks will be whether the impact on demand materializes before the impact on supply and supply restrictions, and that will really shape the inflation profile. And you know what? I mean, the answer depends on medical fact that we don't know yet about the impact of Omicron and the impact of particularly of the booster to protect from Omicron. So there is a lot we don't know, but it's clear that there is one possible scenario where Omicron would increase supply restrictions, would prolong inflationary tensions, and there is a risk then that they become entrenched into expectations, which is certainly what central banks should be trying to avoid. Now, let me just add another thing, which is that, and that was very eloquently said by the OECD chief economist, Laurence Boone, a couple of days ago, that if you compare how much governments have spent on supporting their economies, which is roughly, say, $10 trillion for the G20 economies, to the cost of vaccines, of providing vaccines to the whole world, which would be around $50 billion. So we're comparing 10 trillion and 15 billion. So the cost of protecting the world from the virus is one order of magnitude lower than the cost of protecting the economies. And so there is a massive coordination failure here.
Yeah, a really fascinating study by the OECD. And as you're saying, it really was a call to make sure that vaccinations are widely available to emerging markets rather than focusing in on home countries. Given that, and given that we have seen a lot of these booster campaigns focus on home rather than looking at that 50 billion, which, as you say, in the context isn't that much, how concerned are you about the economy heading forward if governments aren't heeding that call?
Well, there is a lot of uncertainty, and certainly Omicron adds to the uncertainty. The good news here is that governments and central banks have learned from the last couple of years. They know much better how to trace the impact of the virus on the economy. They've built data, very granular data, that help them understand what's going on, and they are much better prepared to face different scenarios than they were when it all started 2 years ago. So I'm fundamentally positive and optimistic about the capability of governments and central banks to react once they have the facts right. And it's a lot about the impact of this variant that we don't know yet.
Well, we love a little bit of positivity here on a Friday, Benoit, so really appreciate that. So you've also launched the New York Innovation Center in partnership with the Fed. This comes after the string of other centers similar that you've launched in other regions as well. I know that there's a lot of work being done here, but what is really the #1 problem for central banks, for these various nations, that these are trying to solve?
Well, it's a multifaceted challenge for central banks to when they want to cope with digital innovation and technological innovation. Innovation is disrupting the way central banks do business in different ways. I mean, it started in payments, of course, and that's the whole discussion about crypto, about stablecoins, and whether central bank digital currency can be part of the solution, and when and how and under which design and so on. But it's also about banking supervision, big data, algorithms being increasingly used, opportunities to streamline banking supervision with new tools and so on. And it's also about green finance, which can be deployed only using new technologies and digital tools and making sense of the data that is around us. And it's also about cyber threats. So you can see that there are a number of issues that central banks have to confront. We've come to the conclusion at the BIS that we'll better do it together by investing, by pooling resources. And that's the essence of what the BIS Innovation Hub project is about.
On the note of cryptocurrencies, how much progress have you seen, you and the team at BIS working with these different central banks? How much progress have you made in terms of having a central bank digital currency?
So different jurisdictions are starting from different places, including depending on their payment systems. Some of them do have fast payment systems. Some of them are planning to deploy them, and so they're starting from different places. But there is common understanding that we need to move together to understand the trade-offs that come with CBDC, central bank digital currency, and that we have to move along several tracks at the same time. We've got to move on retail CBDC, which is digital currency to be used by everyone in the economy. We have to move on wholesale CBDC, which is about big infrastructures and central bank money being used as a settlement asset for interbank transactions, wholesale transactions. And we also have to compare what can be achieved with CBDC with what can be achieved enhancing traditional payment systems. And so we have a number of projects in the BIS Innovation Hub comparing different solutions to the same problem statements. And that's our contribution to the central banking community to draw the lessons.
Really wonderful to catch up with you this morning, Benoit. Unfortunately, we're out of time. Thanks so much for joining us. Enjoy the rest of your Friday and weekend. That was Benoit Corey, head of the Innovation Hub at the Bank for International Settlements. Now, coming up, DD surges in pre-market as it begins the process of delisting from the U.S. We're going to get the latest from Hong Kong. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. The October jobs report beat expectations for job creation.
We're experiencing the strongest economic recovery in the world.
Will we get another great jobs report for the holidays? Find out Friday on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, DD is rising in pre-market, up as much as 10% in some instances. That's after DD started to prepare to withdraw from U.S. stock exchanges after coming under pressure from regulators. Joining us now from Hong Kong is our Chief China Markets Correspondent, Sofia Orta y Costa. Sophia, let's start with the basics before we get to the share price. What do we know so far about DD's delisting?
Morning, Danny. We know that DD plans to delist the shares, but before that happens, to relist, or I should say, prepare for a secondary listing in Hong Kong that would allow for an easy convertibility of the ADRs into Hong Kong shares. That should be relatively straightforward if the IPO in Hong Kong goes ahead smoothly. Obviously, that's very dependent on market conditions, and if you were to IPO now in Hong Kong, market conditions are pretty terrible. We actually had one $5 billion Hong Kong dollar IPO suspended today. So, Danny, the expectation is that DD will file in March for the Hong Kong listing, and then assuming everything goes as normal in Hong Kong, we should get a DD Hong Kong share sale by summer next year, about a year after it listed in the U.S.
Sophia, what do we make of the pop in share prices pre-market, up now about 8.6%?
So you and I were talking over the break about this. So the reaction seems to be we see light at the end of the tunnel for Didi. So this is a company that, I mean, a delisting was one of the worst case scenarios, but the thinking here is that it's being allowed to relist in Hong Kong. It's being given the green light from Beijing. We don't know that for sure, but it's very unlikely that Didi would go ahead with listing plans in Hong Kong had it not had the green light from regulators, not just the CSRC, the securities regulator, but also the cybersecurity regulator, which looks at data security for Chinese companies. And it's essentially a very strong signal. We're also hearing that Didi's apps, this is a ride-hailing firm kind of like Uber, are being seen again on the app stores in China. So again, I mean, the news couldn't have gone, the situation for Didi was already pretty bad, $40 billion wiped out from its market value. So, you know, at least this is progress, Danny.
Sophia, we'll have to leave it there. Thanks so much. That's our Chief China Markets Correspondent, Sophia Orta y Costa in Hong Kong. Now, from one ride-hailing app to another, Grab plunged on its first day of trading after completing the largest SPAC deal ever. SPACs not going away anytime soon. The Southeast Asian super app that offers food delivery, transportation, and digital payment services dropped 21% in its first day of trading in New York. We spoke with the firm's co-founder, who batted aside concerns, citing the resilience of the app strategy.
We chose the path that enabled us to get to the most important objective first, which is to get the best investors for our day one cap table. And with that, based on our PIPE investors that were attracted to the long-term growth opportunities that we've seen, and the very low redemption rates that happened during the de-SPAC process, we are actually extremely happy with the outcomes that we've achieved as well.
You've turned Grab into a super app, including delivery, payments, but also, of course, ride-hailing. How worried are you about a resurgence of COVID and Omicron right now?
So I think a critical part of Grab's growth trajectory over the last 2 years has been our super app strategy that has enabled us to be very resilient to the COVID challenges. To share a bit more about what it is, think about Grab as Uber, DoorDash, and Venmo all in one. Now, from the day when it starts, when you wake up, all the way when you go to bed, you're able to get your breakfast, pay for meals, send your friend gifts, buy groceries, and more. And why that is really important is because it enabled us to have things like shared fleet strategies with our largest driver partner network in the region, which enables our drivers with their super apps to decide if they want to transport people, deliver food or groceries seamlessly in the app, and therefore enabled us to very quickly pivot from mobility to deliveries over the last 2 years. Now, with this super app strategy, we're very confident that we can continue to serve the needs of Southeast Asia's users and our partners, despite whatever challenges COVID continues to throw at us.
Grab's co-founder there speaking with our Emily Chang. Now, we're also monitoring a press conference in Germany with Jens Spahn. This is the outgoing German health minister. As he's been speaking, he said that Germany should have cracked down on the unvaccinated earlier. This, of course, happens as Germany is imposing more stringent nationwide restrictions. So if you're not vaccinated, you're excluded from things like restaurants and theaters as well. Really, Spahn, you're trying to hammer home that, you know, everyone in Germany would either need to be recovered, vaccinated, or indeed dead by the end of the winter. That's what he said just last month, really trying to hammer home that drama that could happen if we don't get more vaccination. So again, this is Jens Spahn speaking at a press conference saying Germany should have cracked down on the unvaccinated earlier. Well, let's now move on and go get your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. U.S. antitrust officials have sued to block NVIDIA's proposed $40 billion takeover of ARM, saying the deal would harm competition in the semiconductor market. The FTC says it is acting to prevent a chip company from stifling the innovation pipeline for next-generation technologies. UK-based ARM is owned by SoftBank and licenses its technology to hundreds of companies, none of which it does compete with. Shell has pulled out of a controversial oil project in the North Sea. The company says the economic case for investment in the UK's Cambo oil field is not strong enough. Environmental groups had criticised the plans, saying they were at odds with the UK's goal of reaching carbon neutrality by 2050. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Coming up, hedge funds are starting to rectify a big diversity problem. Women are now taking the lead at an increasing number of funds, but of course, there's still more work to be done. We get the latest in our Big Take next. This is Bloomberg.
When your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now on to today's big take, and at long last, women are starting to make waves in the hedge fund world. 9 recently open or soon to launch funds started by women signal that change is coming, but progress does remain slow, and of the thousands of hedge funds, only 80 are led by women today. That's according to Kresge Foundation, which tracks the diversity of managers. For more on this, we're joined by our Bloomberg hedge fund reporter, Nishant Kumar. Nishant, unfortunately, this isn't a news story, as we've talked about before. Just how bad is the representation of women in these risk-taking roles in the industry?
Well, it's terrible. You know, that's the only word I can think of that really captures this trend. Here are some statistics that should surprise you, or maybe not surprise you. You know, in UK, more UK mutual funds are run by managers named David than by women. In the US, which is the world's biggest investment management industry, only 11% of the funds are managed by women. That's not the case with other industries. This compares with 38% of lawyers, 49% of judges, 35% of economists, 26% of chief executives who are women. So this is a problem which is very unique to asset management industry. Fortunately, things are changing.
Yeah, unfortunately, I'm not surprised by that statistic, Nishan, on more people being named David. So you say things are changing. What's driving that change?
I think the biggest trend in the industry right now, which is more debate on diversity, rising popularity of ESG-related products, that's bringing a lot of attention to these managers. And to be honest, if you look the data, which is very limited, I agree, from performance point of view, women and diverse fund managers have performed much, much better than average hedge funds in the industry. You take 1 year, 3 year, 5 year, and the data is consistent. So there is a lot of evidence, hard evidence, that you do get some sort of performance edge if you diversify your portfolio to women and diverse fund managers. And then the most important thing, I think, is because there is really a generational shift going on in the hedge fund industry. So some of the women fund managers we have profiled, they have decades of trading experience. They are the best in their game. They have worked at one of the most sophisticated investment firms. So now they are striking out and launching their own hedge funds. And some of them could be more than $1 billion. At least we are guessing 3 of them. So that's quite substantial, a historic moment.
Nishan, thank you so much. Really fantastic story. Nishan Kumar there. Now, Bloomberg Surveillance Early Edition continues in the next hour. It's Jobs Day. We'll have your preview of that and continue the market conversation. We'll be joined by Anna Edwards, Tom McKenzie, and Kaylee Lyons, Matt Miller as well, as we continue to monitor.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Uncertainty going into 2022 is certainly much higher than it typically is.
There's an extremely wide band of probabilities of where things could go from here on.
I hope someday again in my career, we focus on valuations over hopes, dreams, themes, and memes.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Keely Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, December the 3rd. Our top stories today. Fed watchers wait for today's U.S. jobs report. A strong number would reinforce the central bank's hawkish turn. Back from the brink, the Senate averts a U.S. government shutdown by approving a temporary spending bill, and a stunning reversal. After defying Beijing's wishes by going public in New York, Chinese ride-hailing giant Didi is now set to withdraw from U.S. exchanges and sell shares in Hong Kong. Welcome, everybody, to Bloomberg Surveillance this Friday morning. This is the early edition. I'm Anna Edwards with Tom McKenzie in London and Matt Miller in Berlin. Kaylee Lines is off today. And Matt, after an early positive start for European equity markets, we lost some of that momentum, but it's jobs day, so we wait.
Absolutely. And on jobs day, you know, investors sometimes will sit on their hands and wait to see the results before they make their pre-market moves. Of course, the number comes out before the market officially opens, but we do get an indication of what they're thinking beforehand. We also get an indication on what's going on or what to expect in the U.S. from what's going on in Asia. Take a look at the MSCI Asia Pacific Index, unchanged. So I guess not much of an indication there. We do have gains in China. The CSI 300 is up about 1%, but Hong Kong tech stocks are down. And this is, to me, one of the most interesting stories of the day. We're going to be talking about Didi. We're going to be talking about what that ride-hailing Uber rival plans to do. But Hong Kong tech shares have lost $1.5 trillion since their high in February, something Tom knows very well, and you as well, I'm sure, Anna. The yen also, I think, is interesting in that the dollar can buy more yen today, and the greenback is back on the ascent. So the dollar is rising again. Sometimes that means risk off sentiment. Investors are a little bit worried, so they pile into the dollar for safe haven. We'll see how that turns out today. They could just be sitting there waiting for the jobs number. We're expecting, by the way, about 550,000 jobs added. In terms of the U.S. market, you can see S&P futures right now also pretty much unchanged, down a little bit, a little red on the screen, but not too much. The U.S. 10-year yield is down a little bit as well. So here's another sign that maybe investors are looking for a little bit of safety as we await that jobs number. They're buying bonds, which means the perceived safety of government debt is where they want to hide for a moment. Crude is on the rise. That's some risk on sentiment there. We didn't get any more super negative news about the Omicron variant yesterday. President Biden had a speech, but it was mostly just about his plan, the administration's plan to try and fight back. Nothing new there. 68.25 for NYMEX crude. Brent, the global benchmark, is also back on the rise. And here's another risk-on sign. Bitcoin is gaining only 0.5%, which is nothing in terms of volatility for cryptos, but 57,151, so Bitcoin holding a little bit higher right now. Tom, what are you seeing in European markets?
Yeah, Matt, that correlation between Bitcoin and the equity markets over the last few months has been interesting to follow, hasn't it? In terms of the European markets, you're seeing those modest gains, as Anna was saying, as we wait for the new US jobs numbers. And we weigh out some commentary as well from the ECB's Christine Lagarde saying there's very little chance. She's just underscoring this, very little chance of a rate hike come 2022. Again, putting her in a very different position to what we're hearing from the Fed. Basic resources, a bit of a drag over here in the UK, gains of 0.1%. We'll look at the iron ore price shortly. DAX is gaining 0.1%. The CAC going over in France is essentially flat now. And of course, European markets and European governments weighing up these additional restrictions. Matt Miller is living this in Germany as German officials weigh up a vaccine mandate. Across the benchmark then, flat after some more positive gains at the early part of the session. Euro-dollar is at 1.12. Again, Christine Lagarde saying she remains focused on inflation, but she says the inflationary dynamics here in Europe are very different to those in the US. No prospect, very little prospect of a rate hike from the ECB come next year. Iron ore is lower by 3% on the back of some news that China is restricting output once again. You layer on top the real estate dynamics in China as well when you start to consider what's happening with iron ore. Brent, you touched on this, Matt, of course, gains of 2.5% on the decision by OPEC Plus to give themselves some optionality as they weigh up the impacts of Omicron.
Yeah, absolutely. Some interesting developments in the oil space. Interesting to see that the European equity day is split kind of 50-50 with some sectors going higher, some lower as we wait for that jobs report. We're waiting for that. Let's think about some of the other things that lie ahead. It is a big day for US economic data. We'll get that US non-farm payrolls number at 8:30 a.m. New York time to remind you of the timing of that. That'll be followed by October factory orders at 10 a.m. So there is other US data to focus on. At noon, the European Banking Authority publishes its annual risk assessment report with detailed individual data for the banks. And this is after the European close, of course. So that'll be a story to think about on Monday morning as well, if they say anything negative about any of Europe's banks. And Baker Hughes, Tom was talking about oil there, Baker Hughes weekly rig count, that is released at 2 p.m. It's a while since that's been the center of our attention, but certainly with oil prices as volatile as they are, we could focus on that a little more. Now, investors are counting down to the US jobs report, which is expected to show another strong month of hiring. Bloomberg's Danny Berger has more on what we can expect. What is the overall picture? As always, we're looking at the big number here, Danny, but we're also looking at average earnings and participation.
Oh yeah, participation, wages, all of it's going to be really crucial, of course, because this report will set the scene for what may happen in this month when we have a new variant impacting the labor numbers. But 550,000, that is the median estimate. As always, there's some range, a pretty wide range of what could happen of expectations. This would be the biggest gain for the jobs number since July. So if this plays out, it is an overall positive report. But it's not just this that economists want to see to reinforce that the jobs picture is getting stronger. You nailed it, Anna. It is participation, and more specifically, it is prime age participation, because it is still below what it was pre-pandemic. For our radio listeners, I have a chart of that. Essentially, 83 was the high pre-pandemic. We're now just above 81%. This has a lot of cross currents, a lot of things that could impact this. For one, rising virus cases means that more people aren't going back to work. They also have childcare to contend with, but also higher wages, Tom, could indeed mean that this number improves.
Yeah, so that's the granularity of the jobs numbers that we're looking ahead to. How is this likely to play into the decision-making at the Fed when it comes to the taper, Danny?
Well, the Fed has clearly taken a more hawkish shift, so this could easily really just reinforce that picture as well. And it's also no secret that inflation has somewhat derailed the Fed's plans as well. So yes, a hawkish Fed, but many, including Wells Fargo, say, okay, if this number comes in strong, the markets will take it as such. That is the Fed that's going to continue to put their foot on the pedal of tapering back even quicker. I have another chart in front of me for our radio listeners. It's the 2-year Treasury yield. It really is that front end of the curve that's been picked up as we see those expectations for tightening rising. One thing to note, Fed goes on a blackout period midnight US time tonight, so it will be left to traders' imaginations, Anna, for how hawkish the Fed might become after a strong jobs number.
Yeah, absolutely. With not much pushback from the Fed allowed because of that blackout period, we'll have to see how the markets handle the data today. Danny, thank you very much. Bloomberg's Danny Berger with the latest on the jobs report and the Fed's likely response. Now, over to Washington. Congress has averted a US government shutdown Last night, the Senate passed a stopgap spending bill and sent it to President Biden for his signature. The bill will pay for government operations through February 18th. Emily Wilkins, Bloomberg government reporter, joins us now from D.C. And Emily, every time I get a headline that says that we've averted a shutdown, I always look for the date that's attached to it. This can kick to February 18th then.
Yep, February 18th is the new deadline for either when Congress needs to pass yet another stopgap measure or, as lawmakers would like, actually pass a full funding bill for the next fiscal year. I mean, obviously, the thing about these stopgap measures is that it continues funding. It doesn't make necessary changes. Although I will say the one thing that they did include in this bill that's a little bit new is $7 billion for refugees from Afghanistan. Other than that, though, a number of other things are going unaddressed, and that's supposed to give lawmakers just more time to get it together. I mean, this is going to be a very busy December for Congress. We know that in addition to funding the government, they also have to deal with raising the debt limit. And Democrats are still are hoping at least that this month can be when they pass President Joe Biden's social welfare, climate, and tax plan.
So we got a long December ahead of us. I wonder about the Build Back Better bill, not for unselfish reasons, Emily, because I need to know what's going on with the SALT deductions.
And we are keeping a very close eye on that. At this point, it seemed like there was a potential agreement in the Senate, but that's kind of fallen apart in the last week. We're seeing a real discrepancy between New Jersey Senator Bob Menendez. He basically wants to make sure that his constituents are getting the biggest break possible, and Senator Bernie Sanders, who says that the government needs to make sure they're raising some money from this cap so that they can pay for other things such as Medicare expansion for vision and dental. So the debate right now is to give who should be able to get the deduction for state and local taxes. Should it be for those making less than $500,000? Should it be for those making less than $400,000? That's really where the debate is at this point. Lawmakers are continuing to work on it. There's also other questions within the Build Back Better, that social welfare and tax bill. That includes things like paid family and medical leave, which Senator Joe Manchin is not a particularly big fan of, and lingering questions about what, if any, immigration provisions will be in the bill.
Emily, thanks very much. Emily Wilkins there of Bloomberg Government in Washington. Now, the Omicron variant of COVID-19, first identified in South Africa, has now been detected in countries from the U.S. to South Korea. It's spreading around the world, not surprisingly, underscoring the difficulties of curtailing contagious new strains. Germany, where I'm sitting right now, has imposed strict nationwide restrictions on the unvaccinated in an effort to boost inoculations, adding to the clampdown. Officials backed a plan for mandatory vaccinations, which is set for an imminent vote in Parliament. For more, we go to our European correspondent, Maria Tadeo, live in Brussels. So we've got basically a new lockdown here in Germany. Will this work? And what's next?
Yes, Matt. I mean, you're in Berlin, you know it. If you're unvaccinated, essentially, you can kiss goodbye to anything that looks like a normal social life. You're not able to go to the restaurant, you're not able to go to the cinema, and you're simply not able to do anything that doesn't entail essential basic stuff. Now, the thing about the mandate that you referred to, this is probably a vote that will happen before the end of the year and will be operational by the start of next. And it's a huge U-turn from the German government. Remember, they always said from day one, this is a personal choice. The government will never force you to have a vaccine. But what I think this shows, and Matt, I'll be interested to see whether or not you agree, is that one, this really shows the limitations of positive incentives. But two, the German government is running up against a group of Novaks that they probably miscalculated and who are dead sure about not wanting to get this vaccine, who will not do it no matter what you put on the table, no matter how many times you try to incentivize this. Unless you make it an obligation, they're not going to do it. But of course, the question is, what kind of pushback do we get? Austria is one thing. It's a small country. But when you look at Germany, it's 85 million people.
Yeah, really interesting to think about what compulsory means as well, because this could be differently interpreted in different parts of the world. We'll see how that develops. Maria, thank you. Bloomberg's Maria today with the latest on what we're seeing on the European fight against COVID. More now on that Bloomberg scoop on Didi. The Chinese ride-hailing giant plans to delist from the United States under pressure from Beijing. And Tom, you've been following this story pretty closely, looking at the technology side of things in China. I mean, is this pull back to Beijing? There's a little bit of push from New York as well, but Beijing has wanted this for some time.
Well, they've been furious, of course, ever since Didi essentially thumbed their noses at the officials in Beijing and went and listed those ADRs in the US. So it's a consequence of that. But again, as I've stressed before, and I don't think I can really underplay this, everything has to be looked through the prism of national security when it comes to these kind of questions. And of course, Didi has huge amounts of customer data. Chinese officials, lower ranking ones, use this service. They're concerned security services in China, in the US, I should say, might get access to that.
Well, they're not the only ones angry, right? Investors in Didi who maybe didn't know that the Chinese wanted to put a stop to this before the IPO went ahead are already suing the company. They've lost half of their investment if they got the syndicate at the IPO, right? Instead of buying after the pop, in which case they've lost more. My question is, does Didi first privatize? Do they make those U.S. investors whole by taking them out at $14 a share? Or do they just say, look, we're going to list in Hong Kong and we're going to make your $7 and change shares convertible?
Yeah, so apparently there's two options. This is what we're hearing that they're pursuing. One is they're keeping alive the option of a full privatization using state-backed companies. The other is they look to list in Hong Kong, use that funding to help delist in the US. So it's those two dual routes that they are currently pursuing. But you're absolutely right to say that any investor in this company is going to be watching this and is going to be concerned about what they're going to be getting back. 740 now, 780 on Didi, down significantly, of course, from its IPO of, what, 14?
Okay, I have seen some people suggesting, could this be peak regulatory concern, Matt?
Yeah, well, we're going to continue to follow this and bring you any breaking news, any developments on what's going on there. I've got to look at some of the pre-market movers, and one that you had to have your eye on yesterday was Grab, right? This is another company where investors have lost a ton of money on an IPO. You see green here because it's fallen more than 20% from the listing a couple of days ago. Now a little bit of a bounce back. Watch Grab at the open right now in the pre-market. It's trading at 945. More interestingly, I think, is NVIDIA. You know, they were planning the biggest IPO ever in the chip industry, a $40 billion takeover of ARM Holdings in the US, which designs chips, and all of their rivals, or many of their rivals, use those designs, and we're worried that if NVIDIA got a hold of it, they would keep some of the best designs or charge too much for rivals. Now the FTC has said, you know what, we're going to sue to block this. And, well, there's Tesla, and I'm going to get to that in a second, but we're going to sue to block this, and NVIDIA has little chance of winning that lawsuit, so it stymies their plans for expansion. Here's Tesla, the big behemoth, down a little bit in the pre-market right now, but not too much after news that Elon Musk sold basically another million shares in Tesla yesterday. I think 943,000 or 934,000 is what he sold. That's over $1 billion. He's now sold over $10 billion of his stake in Tesla over the last 4 weeks. 4 weeks of selling in a row to offset some taxes on other options he has, but watch Tesla at the open as well. Anna?
Okay, yeah, other governments also expressing their opinions in recent weeks around NVIDIA's intentions for ARM. Now, coming up, 10 outrageous predictions for 2022. We'll bring you the top underappreciated events for the new year. Steen Jacobsen joins us with, as I say, some outrageous suggestions for what we could see next year. And hedge funds' hottest trends is female founders at long last, you might say. We'll speak with 221B Capital Partners, Gillian McIntyre. Plus, later on, we'll get the US jobs report, of course. US Labour Secretary Marty Walsh. That's 9:30 a.m. New York time, 2:30 p.m. London time for that conversation. This is Bloomberg.
think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the US to the UK, and now it's open, of course, to UK nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom McKenzie in London and Matt Miller in Berlin. Eddie van der Veld of Bloomberg Markets Live joins us on set here in London. Eddie, let's get straight to the subject of volatility. We've seen a lot of it of late, some of it this week quite unusual, the extent of intraday volatility. Is that in itself something that worries you?
Yeah, you know what? I think there was so much new to take on this week. We've had the Omicron, ever since last week. I mean, markets still starting to stabilize after that post Thanksgiving sell-off. Then we had OPEC that just kind of rocked things again. And now we're getting into non-farm payrolls. In fact, non-farm payrolls have been so much overshadowed this week that I've had colleagues come up to me and say, oh, I forgot it was jobs day today, because it's just, there's been so much happening. And I don't think that...
Is there one number? I mean, if you get a particularly soft number, could that change the dynamic for the Fed?
I don't even know how the Fed will interpret this, because I feel like this jobs number it's very backward looking, right? Really, what we care about now is how much do they lock down economies? How much do we see the spread? How serious is it when people get it? All numbers that we see now, just tell us about what happened yesterday. Who cares about that? We want to know about, what the data tells us going forward.
Yeah, absolutely. And what does the Omicron variant do? How serious is it for different parts of the population? Because that could have a real impact on participation rate going forward. But that's not something we'll find out from today's non-farm payroll, as you say, a little backward looking. Eddie, thank you very much. Eddie van der Veld of Bloomberg Markets Live. For more market analysis, check out MLIV Go on your terminal. This is Bloomberg.
Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this How story. are you thinking about those dynamics?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Anna Edwards and Tom McKenzie in London. Let's get to the first word news. Credit Suisse plans to restructure how it pays bankers. Antonio Orta Ozario, the chairman, says senior bankers should get more of their compensation in stock with long deferral periods and the chance for clawbacks to increase accountability. Credit Suisse will submit the proposed changes at its annual shareholders meeting in April. Meanwhile, Apollo has revamped its compensation for the firm's co-presidents. Jim Zelter and Scott Kleinman have a shot at more than $860 million in stock payouts over 5 years. In return, they have to meet incentive targets and forfeit unvested carried interest. Apollo is trying to expand from private equity into more services. And a JP Morgan financial advisor is suing the company, claiming that private bankers in another unit have been ruthlessly poaching her clients. Gwen Campbell joined the bank a little more than a year ago with $1.1 billion in assets under management. She claims she was lured into a Shark Tank when JP Morgan hired her away from Bank America. JP Morgan says the suit has no merit. Coming up on the most outrageous predictions for 2022, Steen Jacobsen brings us his now classic list that we get every year from Saxo Bank. This is Bloomberg.
So what happens is that we create icons, we call them tags, and they have a signal within them. And when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command for whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, I don't know, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom McKenzie in London and Matt Miller in Berlin. Kaylee Lyons is off today. Stock market's then fairly quiet, waiting for the jobs report, I guess, Tom, is the vibe we've got going on here. We were all drawn to a particular piece overnight, which I thought was really interesting. Berkshire Hathaway's Charlie Munger saying that now the time is even crazier than the dot-com bust, thinking about the valuations that we've achieved in certain sectors. I wonder if that strikes a chord with some of our viewers and listeners.
Yeah, and that drew him into a conversation about cryptocurrencies, of course, and the run-up that you've seen there. And he was saying, look, what China has done in essentially banning Bitcoin and other cryptocurrencies is the right set of policies, and he wants to see that reflected in the US and elsewhere. Now, the critics, of course, and the crypto fans would say this is a 97-year-old who doesn't understand the technology and the potential.
Right, that's what they might say. I suppose, Matt, when you're 97, you don't have to worry about what anybody says online, crypto fans or not.
I was going to say, okay,
about
boomer, but he's really from the greatest generation, right? I have to say, I love Charlie Munger, but he has fallen under a lot of criticism lately because he considers himself a bit of a hobby architect, and he has designed a dorm for the University of California that houses hundreds of students, many of whom have no windows in their rooms because he put a lot of the rooms in the middle of the building, and he says they don't need windows, they can go out into the common areas. I think, what an interesting guy. I've got to look at what's going on in the markets today. First off, in Europe, we see not a lot of action. Stoxx 600, the European benchmark, unchanged right now. The Stoxx 600 yesterday was down, right? Even though the U.S. rallied, maybe as Kaylee was saying yesterday, playing a little bit of catch up, but we'll see how they respond, how you respond, how we all respond to the jobs number today. The S&P futures are now down 0.2%. We were thinking maybe traders sit on their hands waiting for that number. It comes out in just about 2.5 hours' time. New York crude is up. That's a risk-on sign, 68.18, especially considering the fact that OPEC went ahead with raising production at its meeting yesterday. So NYMEX crude rising, as is Brent. Bitcoin, I thought that was risk-on today. Tom and I were talking about how its correlation to stocks has been interesting lately, but Bitcoin is now back down. Not much, obviously, a tiny move in Bitcoin terms, 56,859. There's a lot of interesting pre-market movers today. DD's the one we've been talking about, and they're seeing a big bounce. Maybe investors are hoping they get a buyout. It could be that there's a DD privatization at $14 a share. That's one plan. They might also just delist at the NYSE, relist in Hong Kong, and make shares convertible at, well, they're $7.80 at the close yesterday, $8.51 if they start trading at this level this morning. NVIDIA also down in the pre-market. NVIDIA wanted to buy ARM Holdings, of course, for $40 billion. Would have been a huge takeover, but all of its competitors were against it. And Anna, as you point out, many governments were against it as well. Now the FTC has stepped in and sued NVIDIA to block the takeover. That may not go through, and investors in NVIDIA are concerned about that. If you're an investor in a rival chip maker, maybe you're happy about that. Tesla down only 0.3%. It's still a big deal for a company of this size, but considering the fact that the founder, Elon Musk, sold, I don't know what else he calls himself, like the king of tech, the CEO, sold 934,000 shares yesterday, or at least the filing went in yesterday. He's sold for the last 4 weeks in a row. He's now raised over $10 billion in the last month for share sales. And the stock is not taking that much of a hit, maybe because, remember, he announced it on Twitter. He polled people on Twitter, and they said, yes, sell 10% of your holdings. So it looks like he's doing it.
So that's what he did. He asked Twitter, and Twitter said, and that's what happened. It's a strange world. Now, talking of a strange world, Matt, here comes a revolution. That's what Saxo Bank is saying. Anyway, the 10 outrageous predictions for 2022 are out. These are the unlikely but underappreciated events that would send shockwaves across financial markets, according to analysts at Saxo Bank. From US inflation topping 15% to a Reddit-induced reckoning for the corporate patriarchy. It's a varied list. Joining us now for more on these predictions is Steen Jacobsen, Saxo Bank's CIO. Steen, great to have you with us. I mean, there are so many I like in here and that really get you thinking. Let me focus in on inflation because, of course, it's Jobs Day in America, and so a lot of us will be thinking, what does that add up to for the macro picture and the Fed? Your suggestion here, and it's absolutely not your base case, I think. U.S. inflation reaches about 15% on a wage price spiral. Tell us a little bit about how that comes about, Steen.
Yeah, and so basically the setup for the 15% being the number comes from the fact that that historically we always had a higher print for the CPI in the upgoing circle. So basically 14.5% being the high in the 80s, hence we put 15 this time. But the actual driver is that I think the market is misinterpreting or not understanding fully that we are actually already at full employment relatively to what people wants to do in terms of jobs. So what we see is the service industry. We see where you have people actually going to work physically and servicing people. They are being enticed. In the case of the UK, lorry drivers get 2,000 pounds to sign on. You have difficulty getting serving at restaurants and the likes. And we think that that ultimately means that these companies have no chance of not actually hiring people because, you know, without service in a restaurant, you don't have a restaurant. So we think that what has been ignored so far, the wage pressure, and especially the wage pressure from the bottom sort of pile of income earners will be too large to not create additional inflation. Add to that energy crisis, add to that
Well, I have to say, first of all, yours is my second favorite annual list. Byron Wien being my favorite, but he has a few decades on you, so you could leapfrog him eventually. And they're not all that outrageous, to be fair. One of your predictions is the plan to end fossil fuels gets a rain check. Now, when the U.S. president goes on bended knee to OPEC asking them to drill for more oil, it does seem likely that we're going to be pushing that target back a little bit.
Absolutely, and that is the story. We all agree on the plan to get to a zero emission by 2030, 2040, or 2050. What no one seems willing to do actually is to tell us how we get there. And in that meantime, we need to probably reclassify nuclear power and probably also natural gas in order to get enough baseload effect in terms of electricity and overall generation of energy. So there is a massive opportunity for an investor in the mining and oil and fossil energy space. And we think almost inevitably, not only outrageous, but also as a real call for 22 that we get a reclassification of nuclear power and natural gas.
And Steen, the Reddit crowd and the meme stock's such a big factor for all of us watching the markets over the last 12 months or so. They find a new target under your scenario.
The what?
The Reddit crowd. They turn their fire on the corporate patriarchy. How does that play out?
Although certainly a different crowd than Wall Street Bets.
Absolutely, and actually that's probably the one I'm rooting for the most personally. I will say, if you look at how Reddit and the ability to actually enable a group of people to take over certain stocks and certain themes, then I think it's almost inevitable that women will wake up and smell the coffee and use their power, not only in terms of purse, but also in their ability to sort of connect behind a anti-patriarchy evolution. I think companies need to be warned and alerted to the fact that there's a rise of these of women that wants to re-engage in terms of the number of C-suite jobs, the number of board jobs, and overall that we get a more balanced pay in this sector. So for that one, I'm actually very, very hopeful that we see some action.
Okay, Steen, nice one to end it on. I'm wearing the shoulder pads, especially. Steen Jacobsen of Saxo Bank, thanks very much for joining us and bringing us your outlook. Coming up, change is coming to the world of money management. Sticking with that theme that Steen left us with there, in fact, the future is female, it seems, for hedge funds. Up next, we'll speak to 221B Capital Partners, CIO and founder Gillian McIntyre. That's next. This is Bloomberg.
to cut emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom McKenzie in London and Matt Miller in Berlin. Now on to today's big take story here at Bloomberg. At long last, women are starting to make waves in the hedge fund world. One of these is our next guest. Gillian McIntyre is the founder of 221B Capital Partners. She first started the Long Short Fund in 2014, but in 2019 turned to launching Appian Way Asset Management to focus on industrials, cyclicals and technology. She's preparing to restart 221B in the new year with an initial $75 million and some high-profile industry backing, she says. Gillian, very good to speak to you. Thanks very much for joining us. And so your profile, part of this bigger piece that our colleagues have written about the rise of women in the hedge fund industry, women still really underrepresented in hedge funds, even compared to other areas of finance. Why do you think that is, Gillian?
Gosh, that's a great question. I just don't think we've had the opportunity at this point. So I started my career in the investment banking industry, which was just as bad back in the early 90s, and and carried through to today. We've just remained underrepresented. But now we're finally, as your article rightly says, I think we're getting some great momentum, and it's partly because the mandates are now there for allocators to actually give a certain percentage of their assets to minority funds.
There's an interesting quote in the piece that our colleague Nishant Kumar and others have written here, which is around what they call a vicious circle. They say that women must outperform men if they want to stay in the business. But even when they do, some investors reluctant to put money into those hedge funds, which keeps those hedge funds small and then means that they can't impress. Is there a sort of vicious cycle that affects hedge funds run by women, do you think?
I think there has been, for sure, but I think that that's definitely changing. And I think that, we're certainly at 221B, what we essentially do, we're a long short fund, but we're very differentiated in our people, our performance, and our process, because we have this ability to identify very good shorts. I was hired by Chris Hahn of the Children's Fund to run his short selling process, and also undiscovered long ideas. So our performance speaks to itself. So at the end of the day, I think that the allocators have to recognize that, and slowly and surely the capital will come flowing in.
Gillian, I've always thought that a diversity of people allows a diversity of viewpoints in a way that kind of the old boys network has never really understood. Does that give you an edge?
Oh, for sure. I think so. Certainly when it comes to finding companies. So just as part of our due diligence process, I think that, part of the reason we're called 221B is obviously after Sherlock Holmes, but we go very, very deep. We look at a lot of things, whether it's things like Freedom of Information Act, it's, consumer surveys. We've identified a lot of very, important information in our process, which we think is highly differentiated to some of our peers.
First of all, it's not terribly obvious to everyone. Sherlock Holmes, I think, was on Baker Street, and I guess 221B was his address. In terms of your investments, are you solely profit driven, or are you also looking for ESG plays? Do those things come together in today's investment environment?
It's a really good question. So the way we think about our strategy is we look at for secular themes, and then we marry those up with bottom-up fundamentals. We don't consider ourselves an ESG fund, but what I do think is very important, and I just presented to the London Business School about this particular topic, is the G is the most critical thing in ESG, meaning the governance. So if you don't have good governance as a company, you're not sustainable. So the E and the S really don't matter at the end of the day. So that's how we think about things. One of the secular themes I would mention is that we're very passionate about is solar innovation. So we think, for example, that the current solar module supply chain will be disrupted over the next couple of years. And that's principally because of the management teams with a lot of the international solar companies. And you've heard things like forced labor, but they also have a very high carbon footprint. So that's one of those things, just to speak to ESG, but where governance plays a really incredibly important part.
And presumably, Gillian, if you find a company that has poor governance, that is a short opportunity. What are the short opportunities in technology in the current environment?
Sure. So, well, I'm not going to name every single one, but I'll highlight one that we did mention in our recent newsletters. So we are a short company by the name of DACO, DQ is the ticker. It's the principal provider of polysilicon into the solar panel market. We question the management's ethics with respect to the production of the polysilicon and also their ties with respect to the XPCC, which is the militia in China. We have a framework that we use called the 5M, which I started back in 2014. And the 5M stand for management, mendacity, which is the fraud, mania, which is valuation, model, does it have a good business model, and then mediocrity, is it consensus. But I would also just highlight that we do find, through our process, we find some outstanding long ideas. One company I would flag on the long side is ASML. We do like that. I took the company public in '95 when I was at Morgan Stanley, and it's compounded at a very high annual rate. So we are very good, very adept at finding long ideas as well as short.
Gillian, thank you so much. Really good to speak to you. Gillian McIntyre of 221B Capital Partners, channeling the powers of deduction, perhaps, of Sherlock Holmes. Coming up on Wall Street Week, we will wrap up the week in markets with Barbara Ann Bernard of Windcrest Capital, Rebecca Patterson of Bridgewater, and more. That is at 6 p.m. in New York, 11 p.m. in London. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I certainly would be supportive of a committee decision to move the end of the taper forward from where people had been expecting it in June.
That was Federal Reserve Governor Randall Qualls speaking to the AEI yesterday. Just one of the Fed voices saying that they would be comfortable with moving that taper end a little bit sooner. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now with a little bit of insight into what is on his mind this Friday morning. Tom, very good early morning to you. And I know you're thinking about the jobs report because it is that kind of a day when we're all thinking about the jobs report. Participation, I saw a great stat yesterday. 8% of those who have lost their jobs during the pandemic say that they are not looking to return back to the workforce, which when we're looking at participation seems like a really important statistic to keep in mind.
Well, the tumult and the turmoil of the present day, Anna Edwards, this chart shows, and this is the greatest social chart in America on labor. That's my opinion. You don't have to agree with me, but here it is, back over 70 years to 1948, after World War II, and this is employed men 25 to 54, and the decline of this is socially frightening. It goes from after World War II to almost 90-some% employed, and down we go to the 1970s in the middle of the chart and the first shock of the manufacturing turmoil of America. And then down even further to the financial crisis and a plunge in the last decade. And then, of course, COVID gets in the way in the pandemic. And it is a stunning less employment of American men. There are 10% less men 25 to 54 employed now than there was in 1948.
Yeah, I found it interesting. Yesterday, Janet Yellen, or was it day before yesterday, in her testimony said she thinks one of the reasons people haven't returned to the labor force post-COVID is that they're still afraid of getting infected. Now, Goldman Sachs, as you know, put out a report saying the main reason is that people have gotten such great returns in the market that they've decided to retire early. Why do you think we haven't seen, I think, 5 million people, Tom, come back?
I think there's a set of reasons, and everybody's grasping straws in the wind trying to come up with a theory du jour. And the answer is we're in the middle of this pandemic. We're still in this pandemic, Matt Miller, and every day it changes. The core thing that we see in New York City is still a lot of work from home. My recent trip to Washington is massively work from home. And that's the big shift, and that's changed. It turns upside down employment. I would say the one resonance I see is the idea of child care in America. We all knew it was failed before the pandemic, and now it's ever more obvious.
Tom Keene on the importance of that labour participation rate within a historical context as we lead up to the non-farm payrolls data out of the States. Of course, co-anchor of Bloomberg Surveillance, thank you very much. Now, a look at what else we are watching. We've been talking about DD, Anna and Matt, of course, because of the implications for that corporate and the investors, but there is a broader read-through as to what happens and what it tells us about the decoupling between these two major powers.
Yeah, absolutely.
I mean, no, Matt, you hold forth.
Well,
no, I was just going to say, what
think...
does it tell us about the geopolitics here? Because I don't worry if German businesses don't list in America. I don't worry if German businesses choose their home bias and decide to list at home. So does it really matter if we see that kind of decoupling, even if we know that the geopolitical tension between these big global powers is ever present and huge?
If it hadn't started, I would agree with you, right? If German businesses never listed here and they continued not to list here, it wouldn't matter. But if they did start to list here and then pulled back because we weren't getting along, that would be an issue. On that note, I thought it was interesting that Charlie Munger, in his talk in Sydney, was saying Australia should really take advantage of their relationship with China to try and mend the relationship between the U.S. and China. I'm watching Whisper Go. This is one of my favorite functions on the Bloomberg terminal because it allows clients to compete with each other to see who is best at forecasting the non-farm payrolls number and a number of other data points. Right now, the Whisper number is just a little bit higher than the survey number at 564.
Okay, I'm watching oil prices. It's been a busy week, of course. Rig Go would be my function. I'll throw that in as well after Whisk Go that Matt was talking about there. We get the rig count a little bit later on. Oil prices in focus as they continue to rise, despite the fact we saw OPEC Plus coming forward with that announcement that they will continue to increase production. Randy Krosner joins the surveillance team next. This is Bloomberg.
An extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the president's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the Q3 was the quarter that was most affected.
This is a much more rapid recovery, and we're very far along towards full employment.
The risks around what the Fed is going to do are to the hawkish side.
They're going to start that journey to normal, and we're going to help them on that path.
The market is really starting to position itself for a little bit more normalization. There's an extremely wide band of probabilities of where things could go from here on.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down 14 TK. We're down 1/3% a few hours away from the jobs report.
And the markets react, and they will react at 8:30 as well, John. What really takes my note, and this goes to the world of John Ferro and Lisa Abramowitz, is the curve flattening this morning is tangible. The two-year yield speaks volumes.
Threatening to break 80 basis points on 2's 10s, Tom, and near the flattest levels of the year so far. We started the program yesterday by saying we don't have a clue what's going on. Seemingly the economists don't either, Tom. 550 is your estimate for 8:30 Eastern time, and the range anywhere from 800K all the way down to 375.
Let's give some litmus paper to global Wall Street on radio and TV. How about the Swiss 20-year goes through to a new negative yield over the last 6 days, a greater negative yield. And John, we have a Euro Swissy with more strong Swissy and well below 104 for a longer period than that touch of a couple days ago.
How will the Swiss National Bank respond to all of this? How will the Fed respond to the data coming out a little bit later this morning? I love a central banker unleashed. A central banker no longer in his seat, or a central banker that has long left that seat. Governor Qualls in the last 24 hours. Shout out to the Wall Street Journal for picking up this quote. We said we'd wait until we see the whites of their eyes. We never said we'd let the army march over us. And so the army is upon us. And so now we'll begin to fire, Lisa.
It's just pure poetry. I mean, honestly, the shift in tone from Fed officials is remarkable, particularly those that are about to leave. Fed Vice Chair Rich Clarida having a similar tone, although perhaps not trying to cast it in the same kind of Homerian light. But there is this issue right now where suddenly inflation seems to have a different imminence for the Fed, which makes me think, John, that this jobs report just has to be good enough for them to keep going with a sooner taper.
I think a lot of people agree with you. Tom Keene, they're all singing from the same hymn sheet.
Is that what that means? Okay, I'm confused. I got too much English literature.
Are you going to keep up with us this morning, Tom? You're doing your separate show over there.
Homerian Unleashed? Okay.
I'm going to get to the price action, Tom.
Please do.
We're negative 10 on the S&P. Let's move the camera in. There we go. Negative 0.2%. Yields in a basis point or two to 142.74 on 10s in the FX market, Lisa. Euro dollar 113, and in the commodity market, positive 2%, $68.11.
Yeah, and we'll get into all of the crude moves yesterday because they really were fascinating and what the behind-the-scenes machinations were there. All right, today, 8:30 a.m., the big moment, the U.S. November jobs report. I am watching the participation rate. I know Tom Keene is as well. How much do we see it increase? There are so many people still out of the labor market. Yesterday, there was a Commerce Department survey showing that nearly a fifth of them are not even looking for work. Why are they not coming back into the labor market? This will be key for the Federal Reserve and key to determine whether we are entering a hotter kind of environment. Today, after that, Labor Secretary Marty Walsh is speaking with a host who I hear has a British accent at 9:30 a.m., Bloomberg Television. And President Biden is planning to comment on the jobs report at 10:15 a.m. I am very curious to watch, in particular, Labor Secretary Marty Walsh with our own Jonathan Ferro, just to see how he casts this. How does he talk about the shift to power to labor? How do we talk about some of the increases that we've seen in wages that are not keeping pace with base consumer inflation, but nonetheless are running at some of the fastest paces that we've seen in decades? And then at 10 a.m., the U.S. ISM services data for the month of November. We are going to see the momentum in the services sector heading into the potential new variant of COVID, which may or may not have lasting power. I want to see what the momentum is like. We already saw some concerns about the Delta variant. This economy, John, needs to shift from buying goods to buying services, and this will be a key indicator to see how far along we are in that transition.
Lisa, thank you. Just getting some commentary from Michael Saunders of the Bank of England over in the UK, Tom, saying Omicron is a key consideration for a December rate decision. That rate decision coming on December 16th. He also goes on to say we likely need a rate hike, and if we move quicker, Tom, those moves can be limited. But that is a key consideration. You'd have to imagine that would be the case 3 weeks away, 2 weeks away now.
Away from this jobs report, John, there's no other topic. Everybody's adapting and adjusting to Omicron in the last 12 hours. I mean, it's literally, folks, by the hour, and we'll keep you abreast of that through the morning.
Waiting for the data. Your equity market this morning, down about 10, negative 0.2%. Your economic data, 8:30 Eastern time. And kicking off the conversation this morning with us is Randy Krosner, former Fed governor and professor of economics at the University of Chicago Booth School. Randy, let's start here. What happened with Chairman Powell this week? What happened with all of them this week? They're all on the same hymn sheet, all singing from the same hymn sheet, and it seemingly come from nowhere for some of them, Randy. What's this about?
So I think they finally got it, that, this is not transitory. As we discussed before, I was hoping they were going to put the transitory language in the dustbin of history, make that transitory. They kept it. I don't think they should have. I think they now realize that this is something that they have to take very seriously, and they worry about inflation expectations getting out of control. And so I think they're making it very, very clear that they're going to speed the taper, which will allow them to start to raise rates earlier. And we talked about this before, that, I thought that's exactly what they should be doing, and I think that is what they will be doing.
Professor Krosner, I did a chart earlier of labor participation of men back to 1948, and it is a changed America. How do you do Fed policy given two Americas? I've got an unemployment rate in Nebraska under 2%, and then we've got 5 million people who can't find a job off of COVID. How do you do a singular policy given two Americas?
Well, the Fed doesn't have the tools to be able to make regional policy. They can only make national policy. And so they have to make an assessment of what's best overall. And I think that they realize that there's a lot, in most markets right now, it's a shortage of labor rather than an excess of labor. There's a lot of pressure on wages. We're seeing wages going up at rates that we haven't seen for 2 or 3 decades, when inflation was a lot higher. We've had low inflation since then. I think that's one of the other things that's concerning the Fed. And so I think they've got to make it for the general policy, for the kind of the thrust of where most of the economy is going, and that's labor shortages, not labor excess.
In about 2.5 hours, Randy, we're going to get this labor market report, and really the emphasis has shifted perhaps to not a hot labor market, but a good enough labor market for the Fed to continue to focus on inflation. Is that the right way to cast this? Is the focus purely on fighting inflation and the labor market a secondary concern for Fed officials?
I think they are concerned about the labor market, but I think the narrative that they have developed is that it's a very, very strong labor market, no matter what the number is. And we've talked about this before, when sometimes the number came out disappointingly low. Well, that was actually a sign of incredible labor market strength, because firms weren't able to get the workers they wanted. We have record number of people quitting. We have record number of job openings relative to the number of people who are looking for jobs. And so I think the Fed has convinced itself, no matter what the number comes out today, that it is going to need to move more swiftly, because they'll either develop a narrative labor market's hot, or they'll develop a narrative that the labor market is so hot that they couldn't hire enough workers.
What's your sense, Randy, of the idea that the Fed is going to have to raise more than people previously expected, that they're going to have to raise faster and to a higher base rate than maybe we thought 3 months ago?
The key thing is going to be how the variant and in particular policy responses to the variant come out. And so if it turns out that, and there's some preliminary evidence on this, we don't have full evidence on this, that the new variant is something that spreads rapidly, but is not very, that doesn't cause much health harm, especially if you've been double vaccinated or especially and if you have a booster, then policy will move away from the lockdowns, will move away from some of the supply disruptions and take off some of the pressures. Also, more people will be willing to come back into the labor market, because this gets back to Tom's earlier point. We're not seeing, a lot of people aren't coming to the labor market because they don't want to be exposed to the virus. And that's totally reasonable. Until they have that confidence that there isn't going to be a new variant, or that the vaccines are effective against all new variants that are coming, you're going to still see low labor market participation and a lot of tightness in that labor market.
Professor, not to do market economics with you, but do you have a call on wage growth and inflation-adjusted wage growth? What's the tone the pressure rather, that you see the Fed having over real wage growth?
Well, that's always the most difficult thing. The Fed has controls over the nominal variables of how much inflation there is, et cetera, but they don't have the control over the difference between the real variables, the difference between the inflation-adjusted or the inflation-adjusted variables. They, of course, would like to see real wage growth, but they also don't want to see nominal wage growth be too high. The only way to get that real wage growth ultimately is through productivity growth and strong investment growth. And that's going to come more to the fiscal and tax side of things.
Randy? Good to hear from you, as always, to
Great
kick things off on Payrolls Friday. Randy Krosner there. On this Payrolls Friday, we've gone through what the banks on Wall Street are looking for liftoff from the Federal Reserve. The likes of Barclays going with May, others grouping around the month of June and July. Tom, a little bit later in the programme, 7 a.m. Eastern Time, we'll catch up with Priya Misra of TD on the patience of TD. They're looking for December 2023, and we'll catch up with Ellen Zentner as well. They're waiting for Q1 23. Just two shops, and there aren't many that don't expect the Fed to hike next year.
And not appearing with us today, Christine Lagarde, but I believe she went out well out into 22 as well today in comments from the ECB. You're right to bring it up, John, and that, the banks are talking and they're doing the parlor game month here, meeting here, but there's a wide dispersion of the what-ifs that everybody has to live with out 2 years.
Well, let's do the what-ifs in this FX market right now. Cable, taking a leg lower, sterling 132.64. I'll give you the headlines and you can trade on whatever you want to trade on. Michael Saunders of the Bank of England saying delaying a Bank of England rate increase may also be costly. He also sees some advantages of the Bank of England waiting for the Omicron data. Tom, a Bank of England rate rise will be limited if we don't delay too long.
The Bank of England unleashed, and of course, John, we saw yesterday Ronaldo unleashed on Arsenal. I thought it was Homerian.
Did you see that first goal, Tom?
He came back.
Did you see that first goal?
The first goal was painful.
If you were the referee, would you have allowed that first goal? We all want to know, Tom.
Get it.
It's the only thing I wanted to know this morning.
I don't understand it, John. It's your sport.
It's your sport too. It's our sport, Tom. It's a very inclusive sport. It's the
Major
world's
League
sport.
Baseball is going to all designated hitter. I'm in mourning.
Futures down 11 on the S&P. On its Payrolls Friday, 550 the estimate, the number, 8:30 Eastern Time. From New York, this is Bloomberg.
I'm Rishka Gupta. Congress has averted a U.S. government shutdown on Thursday night. The Senate passed a stopgap spending bill and sent it to President Biden for his signature. The bill will pay for government operations through February the 18th. Without the measure, the government would have been forced into a partial shutdown after midnight Friday. And it's a stunning reversal for Didi, the Chinese ride-hailing giant that went against Beijing to list shares on the New York Stock Exchange. The company now has begun preparation to delist its shares in the U.S., and it will start work on a Hong Kong share sale. Bloomberg reported last week that China is concerned that a U.S. listing for Didi would lead to the leakage of sensitive data. European Central Bank President Christine Lagarde says an increase in interest rate next year is unlikely, but she told Reuters she won't hesitate to act on inflation if needed. The ECB plans to decide on the future of its stimulus measures on December the 16th. And the Omicron variant of the coronavirus is now the dominant strain in South Africa. That's where it was first detected. South Africa reported more than 11,000 COVID cases on Thursday. Omicron has been detected in more than 24 places, stretching from the US to South Korea. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
India might be securing jobs for its highly skilled elite, complicated, uncertain taxes have pushed most foreign companies in need of cheap labor towards China. That's costing the economy an estimated $140 billion a year.
They've been saying they're open to the rest of the world, but you know, there are still a lot of protectionist barriers on doing business with India.
To follow in China's footsteps and reach the government's goal of being a $5 trillion economy by 2025, India needs to create a model which succeeds both at home and abroad.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We're expanding our national booster campaign to provide booster shots to all eligible adults. Our docs and the scientists believe that people who get a booster shot are more protected than ever from COVID-19.
The President of the United States there, Joe Biden, from New York City this morning. Good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Let's turn to the price action. We're down 14 on the S&P. We're negative about 1/3% into the bond market. Yields coming in a couple of basis points to 142.40 on 10s. A name in the pre-market I want to discuss, DD. There's a push from America. There's a pull from China. These companies are going in one direction right now. Back home. DD getting ready to delist in the US, getting ready to list in Hong Kong, up in the pre-market stateside by more than 4 percentage points. The SEC finally putting into place a new law that mandates foreign companies open their books to US scrutiny. Tom, China and Hong Kong, the only two jurisdictions that refuse to allow this, despite the fact that it's been required since 2002. This story, Tom, is literally decades old, and it's finally drawing to a conclusion.
This is correct. It's decades old, John, and just one quick vignette. I was at the Waldorf Astoria at a packed room as Jack Ma tried to explain the Chinese expansion into Western capitalism. And it was absolutely bizarre then, as it is absolutely bizarre now.
But, Tom, it's beyond bizarre, I think. For 20 years, U.S. regulators, U.S. lawmakers, and in fact, it's not just the United States, allowed the Chinese Communist Party and Chinese companies to play by different rules, believing that ultimately they would adapt out in the future.
Correct, that is
true. That hasn't happened. And what's now happened, after debating this for the best part of 20 years, it's not just the US pushing, it's China actively pulling. The Chinese Communist Party is pulling them home. So they've had 20 years of US capital markets to tap, Tom. They've got their own now, and they're bringing it home. I find the whole story remarkable.
We're going to start off 2022 with an important conversation on that. It's in discussion now with some great experts on China, but I can tell you that it is a movable feast. It's not going to end with 2021. Emily Wilkins knows Washington will not end with 2021, and that was signaled yesterday. I guess there's no shutdown, but what I really saw, Emily, was a reaffirmation of the Republican Party in the singular aloneness of Democrats and the President of the United States. This morning, how alone did Democrats feel?
I mean, this morning, Democrats are at least breathing a sigh of relief. They know that they're not going at this point for a government shutdown. They're going to have a couple more months to get funding together. They've got that February 18th deadline. That's the new one that they have to pull together the funding for the next fiscal year. But let's be clear, this doesn't mean that Democrats are, just completely relaxing. They know that the debt limit is coming up. They know that's something they need to address. They still do not have a clear path forward for how they will be raising the debt limit, and you've seen the House leave today. The Senate's gone. They're not coming back till next week.
That's a political football. Give us Civics 101 here. Do the Democrats need the GOP to adjust the debt limit?
Technically, they don't. They can do it through that reconciliation process that we've been talking about for the Build Back Better, that social welfare and tax plan. They can do the exact same thing. The thing is that it takes time, and it opens Democrats up to a process where Republicans can offer a number of amendments that if, certain moderate Democrats might say, hey, I should probably go ahead and vote for that. That causes larger issues. And so right now you have seen Majority Leader Chuck Schumer, Republican Senate Leader Mitch McConnell going and talking together, trying to figure out what some sort of path forward will be. But again, the clock is running out, and we haven't gotten any sort of agreement from them yet on what that will look like.
Emily, I want to follow up on what John was talking about, this DDD listing from the New York Stock Exchange. Basically, the Chinese government coming out and saying they don't want to subject this data company, this ride-hailing company, to expose their data to the United States. Is it accelerating any of the conversations around trying to restrict some of the capital raises of Chinese companies in the United States?
Well, we have already seen the U.S. Congress, particularly the Senate, move on a number of bills that would sort of punish China or sort of slap some sanctions on Chinese authorities and regulators around multiple different aspects, not just the stock market, but a number of other things. We actually have reporting now on Bloomberg saying that the House is going to be taking up a bill that addresses products that are potentially made with Uyghur labor in potential labor camps, and that's something the House is going to be looking at within the next week of sort of how do you punish these companies? How do you lay down some restrictions on that? Once again, China really does remain in a large part a bipartisan issue in Congress, really one of the few ones. I mean, everyone from the Biden administration to Republicans in Congress understand the need for the U.S. to really remain competitive, remain strong, and to sort of take China very seriously, both as a competitor and in terms of some of the things around human rights, around Taiwan, number of different issues.
What's interesting to me, Emily, is the increasing gulf between politicians and corporate leaders. And we've seen this over the past couple of days in particular. Yesterday, Mitt Romney, the senator, came out and really criticized Ray Dalio in particular for comments that he made on CNBC, basically saying his feigned ignorance of China's horrific abuses and rationalization of complicit investments there is a sad moral lapse. How is this gap getting represented in policy? Is there an increasing attention to Wall Street's conflicting desires from the sort of populist kind of rallying cry?
I mean, at this point, we haven't seen anything particularly notable that would show that some of the attitudes we're seeing from corporate leaders are coming into Congress. For politicians, certainly it's still very popular among Americans to take this strong and aggressive stance toward China, and so that's what we're seeing our politicians do. However, one thing to really keep an eye on, the Senate over the summer passed a bill to increase U.S. competitiveness with China, and now the Senate and the House have agreed to come together and to conference on that bill, trying to get something done. So I'd say that if you are curious about what the U.S. government stance is going to be on China going forward, that's absolutely a discussion to watch. The lawmakers haven't started meeting in this conference format yet, but we did see a number of House leaders meet with Speaker Nancy Pelosi yesterday on what they want for this bill going forward.
Emily Wilkins, always good to catch up with you from Bloomberg Government. Lisa, important to fit this in because this story will get buried by payrolls in a couple of hours' time. I've caught up with a lot of people this week who are still pretty comfortable being in Chinese equities, getting that exposure exposure to that economy still, but just doing it in a different way, I guess. Jay Pilosky of TBW, one of those investors.
Even if they play by different rules, I think investors and frankly corporations are seeing the vast amount of money, the vast economic dynamism coming out of the nation, and they want to participate in it. This is the real issue that I see, especially as you see more of a consensus in Washington, D.C. You also have a consensus in on Wall Street and beyond in corporate America, and it is literally the opposite. They want in.
Yeah, a headline coming out of China as well, Tom. Premier Li saying China to cut the reserve required ratio at the proper time to aid small and medium-sized enterprises. So a rate cut, a triple R cut anyway, could be around the corner.
Yeah, the rate cut could be there in a more accommodative policy as they deal with, the domestic politics as well. I would go back to the party meetings coming up, John, which are absolutely critical. Every China expert says focus on how President Xi deals with these important party meetings.
Tom Keene, Elisa Bramitz and Jonathan Ferro counting you down to the payrolls report. 2 hours and 4 minutes away. Your median estimate this morning for the payrolls report from November, 550K. From New York, with futures down 1/3% on a beautiful Friday morning, this is Bloomberg.
Front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually